The market is very quick to react and change narratives that we're in a Goldilocks scenario and then very quickly say, oh, no, this is recessionary.
With the broadening of the rally that we've seen, we've also seen a broadening in terms of earnings growth.
In terms of kind of the earnings story of the United States relative to the rest of the world, it has been driven by big tech.
It's really the tech sector that is very vulnerable, not because they're not making money, it's just that their valuations are too high.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 negative by 1/3% on the S&P. We are on a 3-day slide on the equity benchmark. On the Nasdaq 100, we're negative by 0.5. On a Russell, we're down by 0.3. It's one line from President Trump helping to send stocks lower into the close in yesterday's session. Tariffs are going forward on time, on schedule.
Jordan Rochester really summed it up well, where he said tariffs are no longer treated by this market as inflationary. They are now considered a growth shock, unabashedly. And that is what you're seeing ripple through markets where you have a rally into bonds, but a sell-off into stocks. This is not what people wanted. It's the reverse of what people expected coming into the year. And it shows the sort of fading of American exceptionalism.
Let's talk about the tariff proposals then. We'll go through the dates once more. So next week, 25% tariffs on Canada and Mexico. The week after that, 25% on steel and aluminum. Then early April, about 25% tariffs on autos, chips and drugs. The month ahead is absolutely stacked.
Absolutely stacked. And also in April, we're going to have the report from USTR, from Commerce, on potentially more tariffs that they deem as necessary for what their favorite word is in this administration, reciprocity, eye for an eye, tariff for a tariff. We should note, though, that if Trump is in full-on negotiating mode and the tariffs are up next week on Canada and Mexico, which he was asked specifically about, we also have reporting that his team was meeting with Mexican officials, telling them, you know what, put tariffs on Chinese companies and their imports. Maybe we can do a deal there.
Check out the bond market. Lisa mentioned it. Yields are down again. Once more, we're lower by 6 basis points on a 10-year, 4.34. On the trade front, focused on the growth hit, not the inflation impulse of the story here. And I think that's really important going into some data later. The key data point later this morning, 10 a.m. Eastern Time. We're paying more attention than usual to consumer confidence. This came from Laurie Calvasina of RBC. The recovering consumer sentiment that's been underway since the recession-like lows of 2022 has been broken.
So here's the question that I have. We have seen in a number of different surveys consumer sentiment getting pummeled in certain quarters. We've been able to say, okay, this is highly partisan. You see inflation expectations and growth expectations going up and down in contrary ways, depending if you're Republican or Democrat. Now we have to see whether corporations start to feel the same thing. We saw that from Walmart earlier. How much do you end up with some of this forward guidance that gives people a sense that maybe that lack of confidence is leading to lower growth estimates going forward?
Futures down 1/3%. Got to focus on the earnings too. Nvidia coming up tomorrow. This morning, dropping right now. Home Depot coming in with an upside surprise. Fourth quarter comp sales coming in at positive 0.8%. The estimate negative 1.71%.
So this is a beat across the board in terms of past performance. The shares are lower by 4.2% because going forward, they see full year comparative sales at about 1% versus an estimate of 1.65%. We have to look through the commentary to really get a sense of the why here. But John, just going back to what happened with Walmart, we heard a sense that they were less confident about the forward-looking outlook because of some of the potential tariffs. We have to see whether Home Depot on their earnings call gives the same kind of sentiment, and maybe that's why the forward-looking outlook isn't quite as positive.
It's almost impossible to provide guidance now. Any kind of outlook through 2025 until we get some clarity on policy. Coming up this hour, we'll catch up with Sharon of Goldman Sachs as global investors weigh renewed trade risk. John Lieber of the Eurasia Group as President Trump says tariffs are moving forward. And Dan Ives of Wedbush as Chinese tech stocks get hit on decoupling risk. We begin this hour with stocks lower, adding to 3 days of losses as President Trump says levies on Canada and Mexico are moving forward on time, on schedule. Joining us now is Sharon of Goldman Sachs. Sharon, welcome to the program. Given the re-rating we've seen on European equities over the past month or so, how vulnerable are they to a tariff hit over the next month?
Yeah, I mean, I think, as you see on your screens now, that everyone is a little bit vulnerable to upping uncertainty again. We clearly don't know what Trump will do when it comes to tariff plans. Even for Canada and Mexico, will they restart again? And is the tariffs that he's talking about sort of a negotiation tool or something that he plans to use permanently? So it's a lot of uncertainty. I think that's extremely unhelpful for growth, unhelpful for inflation as well. But you're right, European markets have done very well this year, but I don't think that's necessarily related to tariffs. I think it's because the valuation gap to the US had just got so large. And European companies are benefiting from a view that maybe there'll be peace in Ukraine, maybe we'll have more fiscal spend from Germany, for example.
Well, that was really the question. Is it just a low bar, or are there shoots, signs that maybe in Europe there are going to be some moves to engender growth? How much, Sharon, are you seeing some of those hopes come to fruition with the latest information about the possibility of expediting some sort of amendment in Germany to get some extra military spending?
So I completely agree that Germany absolutely needs to spend more. Germany is one of the very few places in Europe where debt to GDP is not extremely stretched. And that's because of the constitutional debt rate really having prevented a rise in levels of debt in recent years. So their deficit, their debt, it certainly could be expanded. Now, why would they do that? Because growth has been so weak. We just again had weak growth numbers out of Germany. We know that a lot of industry has been reducing its exposure to Germany. We also know Germany needs to spend more on defense. So I do think, I mean, exactly what guise it takes, it's difficult to know, but I do think the new German administration, as it forms, will be looking to spend more both on infrastructure spend in Germany, but also on defense as well.
Sharon, I got to say, this is one of the most confusing markets to try to understand from a macro perspective I could possibly imagine, let alone the tariff uncertainty, let alone whether Germany starts to spend more. There's a question of what this means for interest rates in Europe and how this rebounds into stocks. The consensus heading into this year was that European rates, the ECB, would be cutting rates more aggressively than in the United States. Now you have a potential growth shock in the United States, or the fear of one. And in Europe, you have the potential for more fiscal spending that actually is sending yields, at least yesterday, marginally higher. How does that factor into the bullish call on European equities?
Yeah, I think in the case of Europe, you're talking about more fiscal spend in an environment of pretty much no economic growth. So it's really to boost infrastructure, reform the supply side of the economy, get growth and productivity improving. I don't think in and of itself it's going to be hugely inflationary, given that you've got other disinflationary things going on. For example, the labour market loosening a little bit. If there is peace between Ukraine and Russia, you may see more energy supplies into Europe. So I think the ECB will be looking at all of those things. We do expect them to be cutting every meeting, just given how weak economic growth is.
Sharon, given where we have the Trump administration and their policy perspectives, you talk about in your note this idea for deregulation, driving of growth. We've heard this from a number of European leaders, but is the rhetoric actually matching what you feel on the ground in Europe and what may be beneficial for equities?
Yeah, I think there are some big levers you can pull in Europe. One of them is for Germany to spend a bit more fiscally on infrastructure. Another one is potentially try and bring down energy prices, getting more gas supply into Europe. Another one potentially would be some deregulation. Europe does have more regulations than you see in the US, or you certainly hear companies complain regulation levels are extremely high in Europe. But it does take a long time to move that. And you've got a lot of different countries with different incentives to regulate. So I'm more sceptical about that one. I feel that more spending on fiscal and defence by all countries in Europe, but especially in Germany, and maybe lower gas, are really the things that are going to move the needle for Europe this year.
We have the UK Prime Minister Keir Starmer coming to Washington this week. He's going to be meeting with President Trump. The two have seemingly had somewhat of a good relationship, having a number of meetings. Do you think there's an investment case for UK outside of the EU right now, especially if they can get to a comprehensive trade deal?
Yeah, I mean, the UK's got some advantages. One advantage, ironically, is it's not a large manufacturing economy. It's mainly in services. It's not that exposed to, therefore, tariffs. And Trump has already said that the UK is not a special target, either of those tariffs. So given those things, the UK is probably less vulnerable to the trade war, to the tariff risk, etc. But it is nonetheless a small, open economy, and it will have some vulnerability to all of that. So I think that's one helpful point on the UK. The other helpful point on the UK, again, is if you did see ultimately a ceasefire in Ukraine, if you ultimately saw gas prices come down, the UK, and particularly the consumer in the UK, is very gas dependent. So those things would certainly help. So there are some elements that could be better for the UK. And then final point on this is the UK indices, stock markets are on a particularly large valuation discount to the US, even more so than the rest of Europe. So again, that may look attractive.
Sharon, just want to wrap it together with a sense of what your highest conviction trade is. After you got it right to start this year, the idea that Europe would outperform U.S. equities simply because of a valuation gap. Is that trade done, or are you leaning into that?
Yeah, this is number one question that I'm getting from clients really at the moment. This is what investors really want to know. Can European outperformance persist, particularly given that we've seen all this before, haven't we? Europe has been a long-term perma underperformer. Every now and again, of course, it has pops of good performance, but will these last? I think this one could be a little bit longer, just because you've got this huge valuation differential between the US and Europe, and maybe it's closed a bit, but even adjusted for growth, which is lower in Europe for sure, we still find that Europe is on quite a big discount. We've had some institutional flows come back into Europe, but they're still quite minor compared to the outflows in the last few years. You do need the politics to go the right way in Europe, and the stuff we talked about before, more spending, etc., by Germany, more defence spending, etc. But yeah, I think there's possibly a little bit more to go.
Hey, Sharon, appreciate your time. Sharon Bell there of Goldman Sachs on the latest out of Europe. Here, stateside equity futures softer by 1/3% on the S&P 500. Some big moves in the bond market over the past 5-6 weeks or so. In the bond market this morning, yields are lower for a fifth consecutive session. On a 10-year, we're down 6 basis points to 4.33. This came from the team over at Mizuho. Jordan Rochester making the following point. The tariffs are no longer treated by this market as inflationary. Going on to say, and instead a risk-off duration rally factor. Going on to say, if the tariffs go ahead on March 4th on both Mexico and Canada, the moves so far may look small in hindsight.
You're getting a number of proposals, expectations, estimates from economists about how much it would cost people. For example, if oil is taxed, and we're going to get into that later, but I will just say, increasingly, the lack of certainty from the C-suite is translating exactly into what you were talking about a couple weeks ago, which is the longer this drags on, the more corporate executives don't make decisions, the more you end up with a stalling out of investment, and that changes some of the optimism that you had heading into this year.
JP Morgan's Jamie Dimon, wait and see. His words in the last 24 hours. Jim DeMare speaking to Bloomberg's Guy Johnson over in Dubai from Bank of America, saying the same thing. Just a lot of clients now slowing down just a little bit.
And we heard that from Walmart as well. How do you come up with an outlook, as you just asked, if you don't have a sense of what the future will bring? We have to wait until the 9 a.m. call for Home Depot to really understand what happened here, because it seemed like they were able to outperform. The more we get this type of commentary, the more you'll see people lean into the idea of a growth shock more than some sort of inflationary scare.
Let's give you an update on Home Depot and a whole lot more with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Starting on those breaking lines from Home Depot reporting earnings. They did beat Wall Street estimates. Shares are weaker in the pre-market, though, by nearly 2%. For the numbers themselves, they forecast comparable sales for the full year of about 1%. They also raised their quarterly dividend by 2.2%. Elsewhere, President Donald Trump says that tariffs scheduled to hit Canada and Mexico next month are on time and moving along very rapidly. The tariffs were initially delayed to allow the countries more time to address concerns over border security and would go into effect on March 4th. But a U.S. official cautioned that the schedule could be less certain. Elsewhere in D.C., Elon Musk said that federal workers will be given a second chance to respond to an email detailing what they did last week or face termination. The federal agency that sent the email on Monday said that it's up to the agency leadership, though, not Musk, what happens to those who ignore the message. President Donald Trump defended Musk's efforts, saying that it is a legitimate bid to root out fraud and waste in the government. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on the program. Trump doubles down.
The tariffs are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen.
Those comments sending stocks lower into the close. We'll get the thoughts of John Lieber of Eurasia Group in just a moment. From New York City this morning, good morning. The S&P on a three-day slide. Equity futures this morning negative by 0.25% in the bond market. What a run for the 10-year Treasury yield, down for 5 consecutive sessions on a weekly basis. We've been lower for 6. This stretch could become 7. We're down 6 basis points this morning. The 10-year 433.86. Under surveillance this morning, Trump doubles down.
The tariffs are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen. I mean, you know, who can blame them if they made these great deals with the United States, took advantage of the United States?
So here's the latest this morning. President Donald Trump saying 25% tariffs on Canada and Mexico are going to hit on time, on schedule next week. Bloomberg's Tyler Kendall joins us now for more from Washington. Tyler, what's the latest?
Well, John, despite President Trump's comments, a U.S. official does tell Bloomberg News that that schedule is less than certain. And while President Trump was responding directly to a question about these pending Mexico and Canada tariffs that could take place in exactly 1 week from now, this U.S. official says that still a lot needs to be determined considering that negotiations are underway. And rather, President Trump's reciprocal tariff plan is still on track. Under that timeline, we are expecting Commerce and the USTR to present their country-by-country tariff findings by April 1st. But so a little bit of couching here, perhaps, by the administration, but still those negotiations on Canada and Mexico, important for us to remember that those are tied directly to some tangible policy priorities for this White House when it comes to immigration and fentanyl. The latter, something that President Trump has tied directly to China. And I mentioned that, John, because just this week, Bloomberg News reporting that U.S. officials have asked Mexican officials to hike their tariffs when it comes to China in this bid as these negotiations continue.
So potentially, Tyler, is that an off-ramp maybe for Mexico?
Well, it remains to be seen. We're really seeing this administration in recent days ramp up their rhetoric when it does come to China. Also, seeing the administration open the door to enacting fees on goods that are shipped on Chinese ships, for example. So potentially this is some room for negotiation. But really, we are looking for whether or not any more tangible policies come about when it comes to Mexico and Canada on the immigration policy, such as an increase in troops at the border, something that Mexico had pledged when President Trump originally delayed these tariffs, as well as what we're seeing any progress when it comes to fentanyl coming over the border.
Tyler, appreciate the update. Tyler Kendall there of Bloomberg. Out of Washington, D.C., to extend the conversation, joining us now, John Lieber of the Eurasia Group. John, just to recap, and welcome to the programme, sir, as always. These are the proposals right now. Next week, 25% on Canada and Mexico. A week later, steel and aluminum. The following month, we're talking about reciprocal tariffs. John, just to recap your base case. What is your base case for what does and does not happen over the next month or so?
So I think that April 1st deadline is the really important one to watch. There's a bunch of investigations directed across the entire government that will be coming out on April 1st. The reciprocal tariffs that were just talked about, the unfair trade practices of America's many trade partners, and I'm sure that we'll see some allegations against countries like Vietnam and Japan and Germany all coming out on April 1st. And then that is going to kickstart a process which eventually will lead to higher tariffs on quite a few of these countries. But in the meantime, this negotiation is going to be ongoing. So, over the next month, you listened to Trump last night. He was responding to a question from a reporter, and he started talking about Canada and Mexico, and he ended up talking about reciprocal tariffs, which are much broader than just Canada and Mexico. So I'm not sure, the president has a way of weaving when he talks, so I'm not sure we necessarily could take this as real guidance as to what's going to happen next week. Our view is that those broad tariffs on Canada and Mexico are likely to be avoided because the two countries are doing enough to avoid them. But April 1st remains the real day to watch because of these other investigations, and the sectoral tariffs are probably going to end up being more meaningful for the North American countries than these broad tariff threats are.
It was a question from our own Jordan Fabian. And in the president's response, this weave, if you will, he did talk about the fact that the agreement under place now is not working. But that deal, USMCA, was negotiated when he was the 45th president. What doesn't he like about USMCA right now that he's so willing to put 25% tariffs on Canada and Mexico?
You know, the grievances on USMCA, I think, are relatively narrow and specific, and I think they have to do with China. Everything else about the USMCA, there hasn't really been any controversy about its implementation. There was an energy case that was brought against the Americans. There was a case brought on some labor issues in Mexico. There's been a few other disputes that have been brought, but they've all been working basically as the plan was sketched out. I think the American grievance here is about Chinese goods in the Mexican supply chain. But of course, because it's Trump, they're also using the threat of tariffs to broaden it out on issues like fentanyl and immigration. So I have not heard the administration lay out a reasonable case of what exactly is broken in USMCA. The Mexico point's an obvious one. You can raise North American content requirements, but it really seems like Trump is using the threat of tariffs to leverage this for other policy goals.
Well, behind the scenes, our reporting is that the Trump administration told Mexican officials they should put tariffs on Chinese goods coming into Mexico. They're concerned about Chinese goods getting through the border. John, is it your base case then Trump is in negotiating mode when it comes to the tariffs due next week?
Yeah, I mean, yes, but I don't think it's about the China issue is going to be settled in the USMCA review, which is not due till the middle of next year. But all of this is happening in the background of that review. They want to force changes to Mexican law, and they want to force changes to USMCA that will make it harder for Chinese goods to get in the supply chain. That, I think, is the context for all of these things. In the near term, though, Trump is trying to fight over these unrelated policy issues that really matter to his political agenda: immigration, fentanyl, crime, the whole suite of issues with Mexico.
John, chaos may be the point. It might be the strategy that Donald Trump uses to try to break through and get some change. At the same time, that kind of chaos is creating uncertainty in C-suites at companies. You're seeing that in some of the earning expectations going forward. How much are some of the rank and file Republicans in Congress right now getting concerned about that?
I think there's quite a bit of concern. And right now, I think that the focus is on economic policy is around the budget, and it's around extending the Trump tax cuts at the end of the year. The real issue that's causing concern in Washington right now among Republicans is Trump's approach on Ukraine, which seems to be taking the Russian position. And that is causing quite a bit of consternation and is taking up a lot of the oxygen in the room. But when it comes to the budget cuts and DOGE, I think these issues actually have quite a bit of support among Republicans who continue to look at this deficit challenge that the U.S. has and see it as a generational issue that there's no real solution for because they're not really willing to raise taxes. So the spending cuts, despite the uncertainty, are relatively popular. I think the tariffs everybody in Washington could do without, except for Trump and his team. But this is just the reality of what happens when you elect a tariff man as president.
John, you said that the pivot toward Russia has gotten a lot of attention among Republicans. What's the explanation for it? How are people understanding it?
I think the president is, wants to end the war, is susceptible to has a relationship with Putin, is susceptible to the Russian message on Putin, on Ukraine, and is sympathetic to what's coming out of Russia right now. And I think that that's a pretty disturbing explanation. I don't know if there's a better explanation for it, however.
John, appreciate your perspective as always. John Lieber there of Eurasia Group. Thank you. I want to turn back to the bond market. Stunning moves we've seen over the past 6 weeks. 10-year yields down another 6 basis points. A rally going into a 5th consecutive day. The 10-year at the moment, 4.34. Said this a few times. Focused on the growth hit. Focused on the growth hit associated with tariffs more than the inflation response that we could get to it.
It's not just the tariffs, it's the paralysis that you're seeing across corporate America at a time when people don't have a certain framework. It's not just some of the threats. It's a lack of understanding of what the goal is or what exactly the process is going to be by determining which tariffs to put on and which not to.
Consumer confidence getting hit. We saw that in the data on Friday in UMich consumer sentiment. Later on this morning, you'll get another read on confidence. Look out for that at 10 a.m. Eastern Time. Up next on the programme, we'll talk about the earnings. We'll catch up with Michael Baker of D.A. Davidson reacting to the latest results from Home Depot. Equity futures. At the moment, we're negative by 0.3% from New York. This is Bloomberg. Three-day slide on the S&P 500 could become day 4. We're negative by 0.25% on the S&P. Just bear in mind, we're still a few percentage points away from all-time highs, and yet we're asking questions like this. Michael Hartnett of Bank of America catching up with Bloomberg's Guy Johnson. The stock market is still the president's traffic light. So what would it take? People would look for something from the administration if the S&P were to drop to 5,600 to 5,700 points. So already this morning, we're talking about the so-called Trump put.
Okay, so there was this theory heading into this year that if President Trump did anything too wild or suggested any tariffs that were too significant, stock markets would sell off to such a degree that you would end up with some sort of check on President Trump. Well, stocks have looked past everything because of that belief and because of a couple others. And the longer this drags on, maybe they'll test that. Is this just the hope, either that people will realize this and be able to present some sort of check? I mean, at a certain point, you have to wonder when some of these proposals will bite when you look at some of the extrapolations out and see what the potential economic hits are.
Seeing them bite potentially in the bond market. Let's get to fixed income. Yields lower for a fifth day on a 10-year. We're down by 6 basis points to 434. On twos, we're down by 5 to 411. Tariffs and the threat of tariffs really starting to bring down bond yields in a way that not many people anticipated coming into the new year.
I didn't talk about auctions yesterday. There was a 2-year auction. It went very well, and that's a bad thing. And that is actually the first time I expected to ever say that going back a couple of years. Today we get $70 billion of 5-year notes being sold, and tomorrow we get 7-year notes to the tune of $44 billion. If these auctions go well, is that a problem, given that the demand is coming amid a backdrop of increasing concerns about growth in the United States?
So if they go well, it's a problem. If they don't go well, it's a problem.
I knew you were going to go here. Yes. I mean, it just depends on the story. No, because if they don't go well and it suggests inflationary fears, that's bad. If they go really well because people are worried about potential even breakdown in the growth narrative, that's also not that great.
The economic data is important. A little bit later this morning, 10 a.m. Eastern time, we'll get the Conference Board Consumer Confidence. This follows you, Mitch, on Friday, which a lot of people made a big deal about. Consumer confidence down, inflation expectations up. Some people, though, poking some pretty big holes in that survey, including BMO's Ian Lingen, who said the move was almost entirely driven by respondents who identify as Democrats, who see prices rising at an annual rate of 4.4% over the next 5 to 10 years, compared to Republicans, who are looking for 1.3%. The survey's partisanship issue has left many, ourselves included, hesitant to extrapolate too much signal from the spike in long-term inflation expectations.
I think a lot of people would agree with that. The flip side is that ISM services came in with a contraction territory for the first time going back to early 2023, and prices paid rose at the fastest pace going back to 2022. Today, you are correct. The Consumer Conference Board information is going to be very important to either ratify or dispute what we got on Friday.
Went back over the comments from Steve Cohen from the last couple of days. Really not great at all. Called Doge austerity, called tariffs taxes, said he was the most negative he's been in quite a while.
He's speaking the quiet part out loud. If you talk to a lot of corporate executives, this is what they say in private, but none of them want to face the retaliation of saying it publicly, and so they want to put a positive spin on it. Do you start to see that weigh on their actual decision making? That is, I think, what you're going to be seeing maybe in the next couple of months, but not yet.
It may only last a year or so, but I think it's a period where the best gains have been had. The comments from Steve Cohen there, down in Miami over the past week or so. Over in the FX market, the euro not doing much, positive by 0.1%. Just to recap, a sneak peek, 104.80 on that currency pair. On our radar this morning, President Trump saying scheduled tariffs against Mexico and Canada are, quote, on time, on schedule. The 25% levies are set to hit products from two nations as soon as next week.
That comes March 4th. Then March 12th, you're going to have potentially 25% levy on aluminum and steel. April 1st, then we're going to get that report from USTR, from Commerce, on potentially unfair trade practices from a number of countries. In between all of this, there is a nugget to know as well. Potentially, March 14th, there could be a shutdown of the U.S. government. So there is a lot of uncertainty right now that is coming out of Washington, D.C. And with Trump saying they're going forward, then you have notes like the one from Goldman Sachs this morning saying, what if oil is hit? That could be $170 per household in terms of extra fuel costs.
Yeah, increasing by 7 cents in the gallon. Retail gasoline prices, if you get that type of hit. Right now, you're not seeing it bleed through to gasoline prices or to oil, which highlights just how much people are shrugging this off as not realistic, even though it is uncertainty.
People keep saying next month, it's next week. It's only a week away. It's all coming up very quickly. That's a week away on Mexico and Canada. The following week, we'll get steel and aluminum reciprocal tariffs in early April. That's all happening very fast. I want to turn to this story. Big sell-off in the last 24 hours. Chinese stocks tumbling, with Alibaba seeing its biggest sell-off since 2022, after President Trump directed CFIUS to limit Chinese investments across key American sectors. The declines threatening a world-beating rally for stocks out of China so far in 25.
What you see right now, Jonathan, actually is CFIUS pretty much does this already. But this directive is a clear sign that this administration is going to be looking at it, maybe with even more of a fine-tooth comb than we even saw in the Biden administration. And what they want is investment into allies, not from Chinese companies. And this directive goes through a number of things as well. They also are going to be looking at how Chinese investment comes not just to the United States, but also outbound investment into China.
One of the interesting things is ADRs, the ones in the U.S. are selling off. The ones in China are not as much at all. And the divergence between the two has gotten to the widest since 2022. Essentially, people in China, in the mainland, are saying, we've seen this movie before. You guys flee when things get rough. We buy. We believe in this story. Which is going to be right? And I think this is sort of an interesting and new divergence with a nationalistic feel in China and, truly diverging markets.
This line in the directive over the weekend from the United States, those companies also raise capital by selling to American investors securities that trade on American and foreign public exchanges. I think that's the line that got our attention.
People feeling like maybe you could be under more scrutiny or face more potential losses in the United States. And we've seen this before. It's sort of this push-pull with respect to some of the indexes and some of the exchanges and whether they want to recruit them or they want to push them away.
We'll pick up on that story in just a moment. We'll be catching up with Dan Ives of Wedbush to get his thoughts on what's happening in tech. I want to turn to this. The midnight deadline for federal workers to defend their jobs to Elon Musk's Doge team has come and gone. The US government's HR office walking back Musk's ultimatum, Musk doubling down, posting on X, failure to respond a second time will result in termination.
And he said this is, of course, subject to the discretion of the president. At one point, President Trump said yesterday maybe you would be semi-fired. Unclear what that means. There's a lot of skepticism on what this all means because some department heads, say you're at the DOJ or the FBI, are telling you do not respond. There is concern for this. Some, I've heard, had lawyers review their 5 bullet points and then they sent it back. So there's a lot of questioning on whether or not would you actually be fired if you didn't respond, especially if the directive of your agency said there might be some concern either legally or with national intelligence if you were to actually send through your 5 bullet points.
The email request was utterly trivial, as the standard for passing the test was to type some words and press send. This is Elon Musk on X. Yet so many failed that even a inane test, urged on in some cases by their managers. I speak on TV. That's mine.
That's your self-eval?
That's my self-eval. Just wanted to let you know.
How did that go?
It went great.
I'm pleased.
Words on TV.
Do the same thing. Okay. It's working out all right. Let's turn to Home Depot. Shares falling in the pre-market trading after the company gave comparable sales guidance below analyst expectations. That stock is lower by 2.2%. Michael Baker of D.A. Davidson has a buy rating on the stock with a price target of $466. Michael joins us now for more. Michael, welcome to the program. Your thoughts on the outlook and how reliable that guidance is?
Well, I think like a lot of companies, they have an incentive to guide conservatively, to guide low, as Walmart called it last week. They called it a starting point. I think we're seeing a little bit of that from Home Depot. They had a very good fourth quarter. You guide a little bit more conservatively, take some numbers down, it helps to set up for beats. I think we'll hear on the call the pace of business throughout the fourth quarter and then early in the first quarter. Some of our data suggests that maybe the end of the quarter wasn't quite as strong and the start of the fiscal first quarter may also not have been that as strong, in other words, February. So I think maybe we're seeing a little bit of a reaction to that in the guidance. But I think overall that this is about trying to set a conservative and beatable bar and then beat that throughout the year.
Michael, as you know, there are plenty of challenges. I think you use the acronym RIFT, rates, inflation, foreign exchange and tariffs. Lori Calvasina over at RBC had this to say on consumer confidence. The recovery in sentiment that's been underway since the recession-like lows of 22 has been broken. Michael, how do you counter that? What do you look at to say that maybe this story is bottoming?
Well, there are a lot of policy rifts out there, as we said. Interestingly, though, we have seen retail sales get a little bit better throughout 2024. 2024 was a below average year for retail sales, but actually a pretty good holiday. So the fourth quarter was the best quarter of the year. That does feel like it paused out a little bit in early 2025. But the consumer is sort of, we would call it mixed. Certainly not as strong as we were during COVID, but recovering in 2024 versus 2023. And we think we'll see a little bit of a recovery in that this year. In fact, again, Home Depot's guidance was a little bit soft, but their fourth quarter was really strong. They comped positively. This was their first positive comp in more than 2 years. So we're seeing a little bit of some early signs of recovery there.
Michael,
I feel like it's paused a little bit in the early part of 2025, though.
Michael, are you saying that talking heads like myself are coming out with this narrative that companies are putting forward these negative outlooks like Walmart, maybe even Home Depot, uncertainty around tariffs and policy changes, et cetera, but really they're just sandbagging us and are going to present amazing results later and are trying to just reset the bar a lot lower so that they get more breathing room?
Somewhere in between. I wouldn't say they're setting up for amazing results, but I do think that they are, your term, sandbagging. I do think that they're giving, again, what we would term conservative. Again, Walmart, they called it prudent. They called it a starting point. Their January, the third month of their fourth quarter, was the best month of the quarter. So their business was actually pretty solid. But there is this incentive to not get too far over your skis, particularly given all the policy concerns. I do think part of the guidance is we don't know. There is a lot of uncertainty. Business is pretty good right now. Again, Home Depot, best comp in 2+ years, but we don't know exactly how the year is going to play out for a lot of the reasons that we talked about. And so why not give a guidance number that we feel like is certainly doable, if not beatable?
Michael, some of the commentary out of the C-suite so far from Home Depot, and it's early yet, the call is at 9 a.m. this morning Eastern time, has talked about how consumers are adjusting to mortgage rates where they are, that these higher rates are actually being more accepted rather than viewed as transitory and a reason to put on hold some of these projects. Is this another way of saying that this rate regime is no longer restrictive, that this is essentially just par for the course? It is the new normal in the housing market.
Right, it's higher for longer. I think that's exactly right. Existing home sales, the numbers have not been great, and we're still sort of towards the lower end of the channel versus the higher end if you look back historically. But on a year-over-year basis, existing home sales have been up now year-over-year, 4 months in a row. Home prices, which is a big driver of home improvement, have been up 18 months in a row. So the housing market has a long way to go in terms of recovering, but it is not getting worse. It seems to have stabilized and, again, maybe getting a little bit better. This is a time, I think, when you buy these kind of names.
Some of the commentary as well, to Lisa's point, expanded upon this. The CFO saying there's an uptick in housing activity and consumers are borrowing against their home equity. If they're borrowing against their home equity, we saw this happen during the pandemic when there was this rush to want to redo your homes. And then consumers have really moved to spending on services and experiences. Are they back to wanting to get back into the redoing their homes and remodeling?
We are seeing a little bit of that, yeah. And we upgraded Home Depot mid last year in anticipation of some of that HELOC activity. We are seeing that. We are seeing consumers take a little bit more out of their home. I don't think we're anywhere near where we were in 2008 or 2006, 7, and 8, but we're starting to get back to an environment where consumers are spending on their home. As it relates to services versus goods, we do track that in the GDP numbers every quarter. Services still leads goods, but that gap has now narrowed versus where it was maybe a year and a half ago. So we are starting to see a little bit more of that spend. And again, Home Depot, perfect example, first positive comp in 2+ years.
Hey, Michael. Appreciate the discussion. Thank you, sir. Michael Baker there of D.A. Davidson. A bit of tension between the results and the outlook, all relative to expectations. The results, the quarterly numbers, better than expected. The outlook, just a little bit softer than expected. The stock at a pre-market negative by close to 2%. With an update on stories elsewhere this morning with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. The U.S. and Russia have voted against a UN General Assembly resolution that calls out Moscow's full-scale invasion of Ukraine. The G7 also failed to issue a joint statement, marking the third year since the start of the war. Sources tell us that the U.S. had opposed language condemning Russia that echoed previous language from the group. Meanwhile, Tesla sales fell 45% in Europe last month, while its competitors saw a surge in EV demand. Tesla sales were affected by production line changes and inventory shortages for some of its models. Elon Musk's controversial political views may have also weighed on sales. He's been criticized in both Germany and the UK. Now, an update on Pope Francis. The Vatican's morning brief said that he slept well all night after reporting late yesterday that he had resumed working from his hospital room. Doctors said that he remains in critical conditions with double pneumonia, but reported a slight improvement in his condition. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, high risk for big tech.
In the equity market, what is most at risk is really things that are extraordinarily high valuations. It's really the tech sector that is very vulnerable, not because they're not making money. It's just that their valuations are too high.
Up next on the program, we'll speak to the tech bull, Dan Ives of Wedbush, in just a moment, live from New York. You're watching Bloomberg Surveillance. Some mild losses this morning, down about 0.1% on the S&P, building on a 3-day slide, the longest losing streak since the very beginning of the year on the S&P 500. You'll notice bond yields are lower again, down 6 basis points on a 10-year, 434.24. Under surveillance this morning, high risk for big tech.
In the equity market, what is most at risk is really things that are extraordinarily high valuations, where the near-term impact of a potential slight slowdown would be substantial. It's really the tech sector that is very vulnerable, not because they're not making money, it's just that their valuations are too high.
So here's the latest this morning. Tech stocks looking to avoid a 4th straight day of losses ahead of Nvidia earnings tomorrow. Chinese tech stocks also plunging on an order by President Donald Trump to limit Chinese investment in strategic U.S. sectors. Bloomberg's Tom McKenzie joins us now for more. Tom, welcome to the program. Over the weekend, that directive from the president dropped. What was in it that really spooked people?
A reminder probably of 2022, John, when, of course, there was pressure on those companies listed via ADRs or the variable interest entities in the US. Those Chinese companies like Alibaba, like Baidu, scrutiny around exactly what the numbers are within those businesses. And finally, they came to an agreement. It took a long time. They opened their books, essentially, those companies in Hong Kong, and allowed US officials to look at that data. But China was very reluctant to go that far. The directive that we got yesterday, or at least over the weekend, suggested that is back in the spotlight. It also suggests that investment flows, US investment flows, into some of those Chinese companies, not just tech companies, but energy and farming as well. That is going to come under greater spotlight. And then, of course, the flows into the Chinese market as well. So on a number of fronts under this directive, there's a lot of vulnerability here, you would have thought, for those exposed to these Chinese names, particularly those with dual-use technology.
Tom McKenzie out of London. Some big moves in the last 24 hours in Chinese stocks. Alibaba down 10%. The Nasdaq Golden Dragon Index down by 5%. Dan Ives of Wedbush joins us now to extend the conversation. Dan, Baba down and down hard. Are the ADRs out of China listed in the United States? How investable are they?
I think look, Lisa hit it. I think Baba oversold here. I mean, look, there's going to be some fear factor, but when it comes to cloud, when it comes to who's going to be the winner in AI in China, I think names like Alibaba, those are names that you own here. I think Bar's going to be a little worse than the bite here. I think that's actually the best reaction that we're seeing in China in terms of some of these names.
They're two different things, though, Dan. The idea of buying in China if you are in mainland China versus buying the ADRs in the U.S. at a time where there is increasing focus on whether some of these companies should be raising money in the United States. Do you think that there will be an increasing divide between the depository receipts and what we see in mainland China or Hong Kong?
Well, I think there will be, just because the worry here in terms of, what could come out of Trump and the Beltway. And then I think the other focus is, even though we're hearing jitters and obviously going to NVIDIA tomorrow, I think more and more investors would rather own big tech. Obviously, there's regulatory risk, but that continues to be, I think, at the top of the mountain when it comes to AI revolution.
Dan, Evercore ISI put out a note saying the sell-off, what's going on in China, is more about sell first and ask questions later. Given this directive from the president is just that, a directive. It's a place of travel where they want to go. How much of this do you read as leverage for some sort of deal potentially Trump might want to do with Beijing?
Look, I was just in Hong Kong, over the last week. I do think that this is all a game of high-stakes poker to ultimately where you get to some sort of deal. Look, I think, given the movements, I get it, but I do think that you're going to get to maybe a lot better outcome here between U.S. and China. That's the thinking. I think, especially in Hong Kong and a lot of investors there, rather than maybe some of the onerous or draconian scenarios that you would have thought, going back to when Trump got elected.
How concerned are you, though, that there are conversations already underway between Trump administration officials when it comes to stricter export controls, similar to what we saw in the Biden administration, but actually even maybe a little bit sharper?
Look, it's all going to be this fine line. And just even think about things like TikTok, right? I mean, that's another chip on the table, just like China has chips as well with Tesla and FSD. Look, this is all going to be in negotiation, but I do believe that there's going to be this balancing act. I don't think this is going to, what I view as like draconianly impact chips, the supply chain, despite maybe some of the fears out there. And I think that's also why he talks to Jensen, talks to Cook, of course, Musk, with a front row seat in terms of this very tricky balancing act between acting tough but not ruining this, what continues to be, I think, the biggest tech transformation in the last 40 years.
So, Dan, one reason why I love speaking with you is because I never know where you're going to be. Today, you're in Kuala Lumpur. You travel around the world. I'm not sure if you're in a yacht, but I am curious about what you're hearing from people around the world when we see some of the uncertainty coming out of the White House. How seriously are people taking that internationally as they decide which tech giants to invest in and how much they can really be confident in the American tech prowess story?
Yeah, I mean, Lisa, I'd say every meeting the last 2 weeks, regardless of what city we're in across Asia, it starts off with that. In terms of Trump, what does it mean, especially a lot of these countries that's gotten crushed, in terms of worries about the ripple effect, in terms of data centers, CapEx, regulatory, and what that means. Look, I think it's just another risk investors are trying to handicap, but a lot of it really just does come down to fundamentals. I think fundamentals continue to kind of drive, and I believe we'll see it from NVIDIA tomorrow. I think some of this stuff does go to the background, but no doubt it has been white knuckles to start the year, just given you don't know what's going to come out from a regulatory perspective in terms of this U.S.-China cold tech war.
Dan Ives in Malaysia this morning, or this evening. Dan, appreciate it. Dan Ives at Wedbush. Dan, thank you. Looking ahead to numbers from NVIDIA tomorrow afternoon.
I love that he travels around the world. We never know where he's going to turn up or what he's going to be wearing. Dan, never change. I do think that kind of view really highlights, though, the scuttlebutt on the ground, an international story in terms of U.S. investments. Again, people still confident about the growth story, but uncertainty creeping in. And it goes back to the theme that we keep talking about, which is how long can that uncertainty drag on before it has a material effect on business decisions?
Over in China, we saw a big pickup in Chinese equities, Chinese tech specifically. Big challenge to that in the last 24 hours. How much was news over the weekend in that directive for someone that follows the politics much closely than others?
Well, when you think of things like CFIUS, it already is doing that. That is the whole point of CFIUS, to make sure adversaries don't have a foothold in the United States. Now, is Trump trying to make it maybe more of a muscular CFIUS? Maybe. But I think this just shows a little bit of a direction of travel. But also, it could be a negotiating tool, because right now, he says he wants to do some deal with Xi Jinping.
It certainly spooked US-based investors investing in some of those names, that's for sure. Up next on the programme, we'll catch up with Mike Wilson of Morgan Stanley, Sarah Bianchi of Evercore, VanLoh of Quantum Capital Group, and Tom Tzitzouris of Strategas as this bond market keeps rallying.
We got some data that was a little bit less than, rosy that we've gotten over the past couple of months, but the picture on the consumer is still the same. It's still really strong.
The economy's strong. Labor demand is actually increasing.
While lower income consumers are feeling inflation in a very visceral way, you may not feel the same pinch as a high income consumer.
We actually see the economy strengthening.
The risk isn't the current state of the economy. The risk is we may be potentially slowing down.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Coming into Tuesday on a three-day slide on the S&P 500, attempting to avoid Day 4, equity futures this morning negative by 0.1% on the Nasdaq 100. We're shaping up as follows. We're down by about 0.2%. Going into some important data later this morning, and we wouldn't usually say this. Consumer confidence at 10 a.m. taking on additional importance following the surprises we got on Friday from you, Mitch.
So conference board data, which is the consumer confidence data we're going to be getting at 10 a.m. Eastern today, is considered less politically influenced than, say, the University of Michigan Sentiment Survey. It also has a wider survey sample. If it confirms some of the pessimism in what we saw on Friday, especially based on what we've seen in terms of how tariffs are being taken in this market, expect another risk-off type leg.
The tariff proposals are not just proposals, apparently. The president's saying tariffs are going forward on time and on schedule.
So that's next week. You've been bringing up a great point, Jonathan. It's just not next month. It is next week, March 4th, the first diary point, as Trump has outlined, for potential tariffs. This comes to Canada, Mexico. At the same time, how much is he in negotiating mode? Because we do know that members of administration have sat down with Mexican officials saying, look, maybe there'll be room here if you put tariffs on Chinese imports. That's really what they're concerned about. But this story that this could potentially be hurtful to growth has been happening for weeks. Ken Griffin said it would be a huge mistake.
It's showing up in the bond market. Yields down across the curve. We're down for a 5th consecutive session on a 10-year maturity. We're negative by 6 basis points. Mike McKee writes in. Mike McKee says the markets overnight priced in 2 Fed rate cuts this year for the first time since the December Fed meeting. The first in July at the moment, the second in December.
Follow the data. Take a look at the Citigroup U.S. Surprise Index. It's actually gone negative for the first time since late last year. You're seeing a trend in the data that shows that maybe either we weren't as strong as we thought we were to start the year, or potentially the lack of certainty is starting to bleed into maybe what customers and what businesses are actually doing. This remains to be seen. How long does this drag on?
Home Depot, good example of that. Earlier on this morning, they come out with numbers. The numbers themselves for quarterly results, pretty decent, better than expected, delivering some growth. The outlook, not as good. How can you provide an outlook in 25 without really understanding what the policy is going to look like?
Although Michael Baker was saying that maybe they're just using the uncertainty to lower the bar so low that it's the classic sandbagging opportunity for salespeople, where they give a really low target, they jump over the bar, and they receive kudos. So we shall see exactly how this transpires. The longer this drags on, though, the more realistic it's likely to become.
That stock is down by 1.7% in the pre-market. Coming up on this program in the next 60 minutes or so, we'll catch up with Mike Wilson of Morgan Stanley with stocks on a 3-day losing streak. Sarah Bianchi of Evercore as Trump pushes for peace in Ukraine, and Will VanLoh of Quantum Capital Group as AI fuels energy demand. We begin this hour with stocks lower as traders weigh fresh tariff uncertainty. Mike Wilson of Morgan Stanley says the focus is shifting to growth, writing potential growth headwinds from DOGE, tariffs and immigration have come together to reinforce the view that the first half of 25 will be choppier for stocks than what we experienced through much of the fall of 2024. Mike joins us now for more. Mike, good morning.
Good morning, John.
Are you seeing those growth scares reflected in market internals in a more pronounced way in the past few days?
Well, not just the past few days. It really started in December when rates kind of got through 4.5%. That was the first shot across the bow. And then obviously the policy announcements that we expected, the initial announcements are all kind of growth negative and probably not conducive for inflation either, which keeps the Fed on hold. So the combination of all of that. I would also throw one more into the hopper, which is sort of AI CapEx, which is now being called into question that, there's a deceleration going on. DeepSeek didn't really, help that, sort of view. And that's where the leadership has been. So, a lot of the reasons why, Germany and Europe is rallying and even China was because the Mag 7 has really underperformed. So there's a lot going on here. I want to go back to what we were talking about earlier in terms of the consumer confidence number. Lisa, you mentioned that it's a conference board coming out. That one is very centered on the labor markets, whereas the University of Michigan is more about financial, positioning, like how do consumers feel about their financial standing. So this is an important one because if that's really, really weak, the Fed may pay attention to that. They know that. And so it could be a positive in some ways because everybody now assumes the Fed is on hold, at least probably through June. That's our view too. But if you start to see more signs that the labor market is weakening, that will give the Fed room to maybe bring that cut forward. So there's a lot happening. I think this is what we expected this year in the first half of the year. The last thing I'll bring up is the economic surprise index has a 60-day lag with 10-year yields. So part of the reason why we saw an increase in economic surprise is because rates went down so much in the fall. Now they've gone up. And the good news is that if that stabilizes here at 435 or so, you may see then a pickup. So it's just this ping pong back and forth, and it's a trader's haven, but it's not great for deploying a lot of capital.
So let's unpack some of it, and let's start with tariffs. The overhang that we've got for the next several months, potentially, maybe the next several years, I don't know. You're talking about the level of confidence that consumers have at the moment. Where's the pricing power? And let's think through it in a way that you and the team have. Services versus goods. Where's the pricing power at the moment?
It's exactly what you said. It's in services. That's where the demand is greater. I mean, consumer goods is in deflation. And that's been one of our themes for quite a while. Now, if you add tariffs to that, then you could argue margins get pinched even more because they can't even pass it on. So that trade's worked extremely well. It's probably worked too well, quite frankly. I mean, the spread between consumer services and consumer goods, I tend to like to fade those things here, but not for fundamental reasons, just because technically it's kind of overshot. Other areas where there's maybe some pricing power could be in financials to some degree. There's still pricing power there. Anything that isn't affected by tariffs, I think, looks better at relative. Software over semiconductors is another example where semis have pricing pressure, and software is not as affected by the tariffs.
So people pegged you as a bear on the market for a number of years. People said, oh, here comes bearish Michael Wilson. I'm sure you got that all the time.
It's not what they say when Mike walks into a room.
Well, I bet that a lot of people did.
That's what Lisa says.
I'm a Bears fan.
Okay, hold on a second. People say that about me too. But actually, what you're saying is actually quite bullish, because ultimately you're saying that this ping-ponging is a trader's haven at a time where the U.S. is not on verge of collapsing, and that actually lower rates could fuel another leg of equity optimism. You wrote it's premature to conclude the rotation away from the U.S. is sustainable. Do you think that we're set up for another leg higher on the expectation that maybe the Fed's going to cut into potential weakness?
Yeah, the way we view it right now is that the index is not exciting. Okay, we said 6,100 almost 3 months ago. By the way, we called 6,100 when people were bearish. So, we're not always bearish, just to clarify that for folks. But 6,100 has been a really formidable level. So index is not interesting to me right here. It's kind of stuck. But there's plenty of stuff to do under the surface. I mean, that's our job. There's always something that's bullish, and there's usually something that's bearish. And that, as an investor, that's what you're trying to do. Avoid the bearish things and embrace some of the things that are more bullish.
Are there more opportunities in the U.S., though, to your point, than, say, in Europe, at a time where a lot of people are saying that rotation into Europe has more legs?
Well, think of it this way. So there are more high-quality businesses in the United States, okay, period, end of story. And that's what's working. So the quality factor is continuing to carry the day. So if you look at the concentration risk in the U.S., people go, oh, my God, there's 5 stocks that are like 35%. If you go to Germany, it's like 3. In Asia, it's even worse. You look at the mid-cap index in Germany, okay, it looks worse than the Russell 2000 on a relative basis. So it's just the same story everywhere. And what we've been very consistent about is, in this environment where there's uncertainty, rates are probably still a little too high for the average business. The market's paying up for quality. And in that sense, yes, there are more high-quality companies in the U.S. than there are outside of the U.S., so there's more opportunity, but then there's valuation. And so that's what we've adjusted in the last 3 or 4 months, is that the U.S. just got a little too rich relative. Now I would argue that relative valuation is probably where it should be. And so it's back to stock picking, it's back to factor selection.
You said American exceptionalism in your note has been one of the driving conversations you've had with clients. But what you're saying here right now doesn't sound like investors are falling out of love with America. They're just falling a little bit more in love with Europe.
Well, they're falling a little bit out of love with the leadership at the moment, which, in other words, they got tired. We had incredible performance into basically end of November last year. We kind of hit some targets, and then, of course, this deceleration in some of the numbers. One thing you mentioned, economic surprise factors have rolled over. Boy, earnings revision breadth has rolled over even harder. But it's getting to a point now where it's so extreme. So here's the 2 options I think we have. We could come into March. The numbers have been sandbagged. By the way, seasonally, that's what companies do. They sandbag the most in January because it's the beginning of the year. We wrote about that in December, like, look out for the sandbag. Okay, here it comes. But now the numbers have been reduced. So we could go into March and maybe we start to hear that maybe things aren't as bad. I suspect that the U.S. companies will sound better, relatively speaking.
Are you saying just ignore the guidance? That when people come out and they say uncertainty, ooh, numbers look bad, just ignore, fade whatever move comes on the heels of that?
I wouldn't say that. I would say that numbers are managed, okay? The companies are very good at managing numbers quarter to quarter. They're not as good as predicting the full 12 months. No different than the rest of us, right? It's easier to see 3 months than it is to see 12 months. So I think they're doing what they should be. They're being prudent about saying, we don't really know here. By the way, don't forget, rates and dollar were stronger. going into the end of the year, which affected fourth quarter numbers. The fourth quarter had already been done. They manage those. So they had to just lower the bar just for those two items. Now add in tariffs, add in uncertainty around the world, and why not lower the bar? They didn't get punished that hard, for crying out loud. The stock goes down 2, 3, 4%. It's like, okay, fine, we're up 40 over last year. That's good management of your earnings guidance.
Well, how much do you think earnings are going to be affected by tariffs? You're talking about March. As Jonathan keeps pointing out, that's next week.
That's right. So we did some math on this, and it all assumes how long they stay on. So if you assume that the 25% tariffs stay on Canada, Mexico, and the 10% tariffs stay on China through this year and into 2026, we think it's about a 5 to 7% hit. So it's not insignificant. I mean, that will take us down to 5,500, probably no problem. I don't think the market believes that at the moment. I mean, we haven't seen the numbers come down, but we're talking about, I don't know, $10 to $15 hit to S&P earnings. It's not insignificant. So this is going to be a cat and mouse game throughout the year, no different than it was in 2018. Interplay with how that affects Fed policy as well. They've already mentioned that this is holding them back. So, we're dealing with it. And one last thing I just want to mention on this. I think people assume that President Trump is very focused on, he's not going to let the stock market go down. I have no idea, but he hasn't been talking that way this time. And I think this sort of idea, I know Scott Besson was on your show talking about Main Street versus Wall Street, and that is sort of, I think, how they're evaluating themselves, is how do we get Main Street to participate more in this economy kind of writ large, and shrinking the government, getting that crowding out of their hair, deregulation. Let's get rates down at the back end. They focused on that because that's what affects mortgage rates and things that American citizens care about. Okay, so I think there's a lot going on, and I am optimistic that a year from now that I think the structure of the economy is going to be healthier if they can succeed in doing these things without damaging too much. So, but the path from here to there is going to be extremely messy.
Mike, just quickly, Michael Hartnett spoke to some of those issues that you've just brought up. He said the stock market is still the president's traffic light. Are you suggesting that that's not the case anymore, or just suggesting that the equity market has to fall a heck of a lot more than it has already?
I don't know, because what I can tell you is that I haven't heard him talk about the stock market. Okay, whereas I think in the first term it was all about the stock market, and now they're focused more on immigration, border, law and order, sort of basically things that can help the American citizen, maybe small businesses. There's a focus there. And then, of course, DOGE and what that can do to liberate the private economy. That's the storyline. And to me, quite frankly, that's a better storyline than perhaps, the first term, which was kind of about just, pushing. You can't really do that this time, right? Because the crowding out has already kind of limited you on where rates are. So you can't just push on reflationary strategies now. In 2017, when we were really bullish on, Trump's reflationary story, and it worked, you had a lot of slack in the economy. Today, you don't have that slack in the economy. I think they understand that.
Mike, appreciate the update and your view, as always. Great insight. Mike Wilson there of Morgan Stanley. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. U.S. Treasury Secretary Scott Bessent will meet with Australian Treasurer Jim Chalmers in Washington today. The counterparts are set to discuss Australia's pitch for a tariff exemption and then address a summit at the Australian Embassy. A resolution on tariffs is not expected today. Eli Lilly cutting the price of some of its obesity drugs to combat cheaper copycat versions. The company said in a statement that it's reducing the cost for its 2.5 milligram and 5 milligram Zepbound vials to $349 and $499 a month, respectively. That's a cut of about $50. Eli Lilly is also making higher dose vials available for just under $500 a month. Bitcoin dropped below $90,000 today for the first time since November, following the post-election rally. The drop comes after tariffs and wider geopolitical uncertainty weigh on the broader markets. That alongside with some industry-specific setbacks, like the biggest ever crypto hack and a meme coin scandal involving Argentinian President Javier Milei. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, negotiating peace in Ukraine.
We're working on deals right now, transactions right now, and in particular, the big one is to get the war stopped, whether it's ceasefire or direct to an agreement.
A conversation up next with Sarah Bianchi of Evercore from New York City. This is Bloomberg. This bond move, another leg lower for 10-year government bond yields. We're down by 7 basis points now. The 10-year 432.51, building on 6 weeks of gains for 10-year treasuries. Yields lower across the last 6 weeks, and it could be week 7.
And this comes as there is evidence in disinflation. We're going to get that core PCE reading on Friday that's expected to come in at a 7-month low at the same time that really these tariff threats are starting to become more growth concerns than they are inflation.
Under surveillance this morning, let's talk about foreign policy, negotiating peace in Ukraine.
I will be meeting with President Zelensky. In fact, he may come in this week or next week to sign the agreement, and which would be nice. I'd love to meet him. Would meet at the Oval Office. It'll be a deal with rare earths and various other things. We're working on deals right now, transactions right now, and in particular, the big one is to get the war stopped, whether it's ceasefire or direct to an agreement.
So here's the latest this morning. President Trump reiterating calls for an end to the war in Ukraine while meeting with France's President Emmanuel Macron at the White House. Joining us now to discuss is Bloomberg's Tyler Kendall. Tyler, those two doing a great job of showing that you can still be friends when you disagree with each other. Did we make any progress whatsoever yesterday?
Right, John. The French president repeatedly calling this meeting a turning point, although it is evident that big risks still remain. Macron suggested that Europe is looking into some sort of framework to get peacekeepers on the ground in Ukraine, but suggested that the U.S. should underwrite it in some way in order to lend credibility. I actually spoke to one foreign policy expert who echoed that sentiment, said it's difficult to see sustained peace without some sort of U.S. deterrence. But noticeably left out of these conversations and the headlines are any such guarantees from this White House. Instead, we're really seeing administration officials and President Trump push ahead with this economic cooperation agreement when it comes to critical minerals. And we've seen administration officials instead say that those security guarantees would rather be implicit, considering that the U.S. might have a vested economic interest in the future of the country. John, President Trump has repeatedly said that that deal is critical in order for the U.S. to get back on its investment. But we should note that Ukrainian President Zelensky has repeatedly asserted that the conditions for that aid was negotiated under the last administration and doesn't amount to any sort of debt.
Tyler Kendall from the nation's capital down in Washington, D.C. Tyler, thank you. Joining us now to build on that conversation, Sarah Bianchi of Evercore. Sarah, the sitting president taking a very different approach to the situation in Ukraine. Some people suggesting that this is designed to shock the Europeans into action. Do you agree with that?
Oh, well, it certainly has had that impact. We're seeing, obviously, with the Macron visit, but also the British Prime Minister coming. I think, look, the events and remarks from Vice President Vance and the Defense Secretary certainly made the Europeans realize that this is a different administration, in case that hadn't already been clear. And so I think they are rushing over to try and get into meet with Trump and get into this sort of transactional aspect of the way he does business and making sure they're part of that conversation.
Sarah, under the Biden administration, there was this conventional thinking, they said the intelligence supported it, that there was no way Putin wanted to come to the negotiating table. Trump is basically flipping that on its head. And with his rhetoric, is that what is bringing potentially Russia to the negotiating table? Because the end goal, he continues to say, is that he wants to end this, and he wants at least in the minimum a ceasefire.
Well, I actually think it was a good decision for President Trump to reach out to Russia and to bring them into this conversation. I think the concerns, obviously, on the European side were some of the public offerings of negotiating and taking things off the table ahead of negotiations. But I think, look, he has his own way of doing business. It's obviously causing some consternation, but I do think look, all parties have to be part of this conversation if we're going to get the ceasefire or resolution that people are hoping for. And honestly, that probably includes Russia as well as Ukraine.
There seems to be this fast track potentially for this mineral deal. Trump even saying Zelensky could come to the United States as soon as this week. Do you think implicit in a mineral deal would be security of Ukraine because of how close U.S. investment and protection of those raw assets could be?
Look, the critical minerals deal is very kind of unique to Trump. I think it's caused everybody and all the parties to rethink kind of what is needed here. That is certainly not what Ukraine was expecting under the last administration. But I think they're trying to figure out, what cards they have to play here, and to get the kind of guarantees that they're looking for, it does appear that they might have to at least agree to something with regard to minerals. That's the cards they have right now. So I think they'll come and try to make something, but I assume he'll be looking for some pretty ironclad guarantees in return.
There's a broader question here about whether all of this is a negotiating tactic to try to bring resolution to the Russia-Ukraine war and get peace, or whether this is a reordering of the global order where essentially friends, enemies, it doesn't really matter. Everything is a transaction. Which is it from your point of view?
Probably some of both. President Trump has always viewed relationships as transactional. We saw that in the first term when he was looking at the EU saying, gosh, the tariffs aren't fair, or steel and aluminum is not fair. So he looks at every relationship and wants to understand what the United States is getting out. So I think that underlies everything. He also uses negotiations and kind of shock and awe tactics to bring resolution. So it's just a matter of everybody adjusting and trying to see what the end game is. But certainly is causing a lot of divides in what's been a very historically strong partnership between the EU and the United States, and that is certainly causing alarm bells across the continent.
Meanwhile, there's a discussion about what the longer-lasting implications of this there are. So are you getting a sense that the ultimate goal really is a separation between the U.S. and China, but sort of a negotiation, as you said? What is the U.S. getting from places like Europe, Mexico, and Canada? Is that sort of how you see the framework evolving?
Well, certainly he's going to look at what he's getting from any allies. We see that in Canada and Mexico around the fentanyl negotiations. We see that in Europe. I think it's a little bit unclear where Trump is exactly heading on China. There's a lot of different aspects that he needs to solve for in that relationship right now. Sometimes he likes to talk about this notion of a big deal with China, but on the other hand, the steps we've seen from his administration so far, whether it be a stronger CFIUS rules, 10% tariffs across the board, are really anything but. So I think the China relationship is evolving and a little bit kind of behind some of these other things. But what is most different about this president is how he thinks of allies in terms of a transaction and what the United States, in his mind, is getting out of any one of those relationships. That is night and day as compared to how President Biden thought about the role of America in the world.
Sarah, appreciate it. Thank you. Sarah Bianchi there of Evercore ASI on the latest between the United States and Russia, the US and China. Annmarie, you've pointed this out repeatedly. The one policy change we have seen on the trade front, tariffs on China. They've stuck.
It's the only one that have actually went into place when Trump said they were going to go into place, an extra 10%. And when you talk to administrative officials, they say this is the opening salvo when it comes to Beijing.
But when you hear from the president, there's more tariffs going on schedule, on time, maybe as soon as next week. Up next on the program, VanLoh of Quantum Capital Group, as the rise of AI fuels a surge in energy demand. From New York, this is Bloomberg. Three-day slide on the S&P 500, attempting to avoid day four. Equity futures just about unchanged and turning positive in the last couple of moments. We're down just 0.1% on the Nasdaq 100. With an update on your movers this morning, let's cross over to Yahara Hackers for more. Hey, Yahara.
Hi, John. We start with Home Depot. Those shares are now up here in the pre-market. The company said it will finally return to growth this year, but actually not at the amount that investors were hoping for. They say comparable sales will rise about 1% this fiscal year. That fell short of analyst estimates, which was 1.65%. But as you can see, the shares are now reacting positively here in the pre-market after falling lower earlier. Next up, we have Hims and Hers. That stock is absolutely plunging here. It's down 22% after executives confirmed that they will no longer be selling their compounded weight loss drugs because the FDA has declared that semaglutide is no longer in a shortage, and that shortage was what allowed them to sell these copycat drugs. But in the next month or so, the CEO said it's going to start telling customers that they're going to have to seek other options for that. And let's get a quick check on Nvidia shares. Yes, we have earnings out tomorrow, but the stock is seeing a little bit of a hit, down about 0.8%. And part of that could be the story that we have out today, that the Trump administration is drawing up tougher chip curbs to contain China's tech ambitions. So that idea that more controls could be put in place could be what's weighing on the stock right now. John?
Stock is down by 0.8%. Yahara, thanks for that. More from Yahara a little bit later on this morning. On our radar this morning, President Donald Trump saying tariffs scheduled to hit Canada and Mexico next week are moving forward. But a U.S. official telling Bloomberg the fate of the 25% levies is still to be determined.
Because they're negotiating. We already have reporting that they sat down with Mexican officials looking at more ways that Mexico can maybe combat some of the imports that are coming in from China and then basically leaking over the border. So Trump is going to, even if the tariffs are not coming into place on Tuesday, Trump is still going to verbally talk about this maximalist approach, because if he's in the deal-making mode, he's in negotiating mode, and he's not going to give an inch, definitely not publicly.
People are getting used to ignoring some of this because it doesn't come to fruition. Let's just be really honest. The rhetoric is getting heated on all sides. The retaliatory potential tariffs coming from Canada, pretty heated last night between Mark Carney as well as Freeland when they were having, the Chrystia Freeland, when they were having a debate. So you have to wonder, is this just sort of heating up the animosity before some grand deal? Are we going to have fights at hockey games from here on out? I don't know.
I hope not. I don't want fights like in the stands.
That's what happened.
On the rink, sure.
On the rink. Well,
that's fine. I mean, that's what the game is all about, right?
Yeah, but, in the first 10 seconds, and honestly, when Canadians boo us, I mean, we've got to take note, because Canadians are so nice.
I know. Mike Wilson of Morgan Stanley was with us earlier. Mike, I think, framed things really well. The way to think about this maybe is that we could have a lot of government at the border and a lot less government within the United States of America. At the border, immigration, tariffs. Within the United States, lots of cuts to regulation, cuts to spending. The issue with that is that you have to take some pain up front to really get into the dynamism you could see further down the road, 4 or 5 years out. And it could go beyond his second term, to be honest with you. This is a grand vision. How much pain they're willing to tolerate is the interesting piece of this here. And I think it's only just started in the equity market. And I think we keep saying, and we're right to say this, we're only a few percentage points away from all-time highs in the equity market. This is not some big gap lower on the S&P 500. But if they're serious about this, you will have to take some pain to get those gains further down the road.
Serious about this, we need to define that. And I think you're absolutely right. If it's cutting the deficit, yes, we're on a fiscally unsustainable path. If it's cutting regulations, yes, it's a question of how you do it and whether there is a framework and a goal that people can see, or whether it feels like chaos. And that, I think, is really a question to be determined.
It's going to take some time. What are we, 5 weeks into this now, officially?
Yep, we basically are halfway through.
The fifth week in. Equity futures on the S&P just negative by 0.05%. Let's turn to this story. The US voting against the resolution in the UN General Assembly that calls out Russia's full-scale invasion of Ukraine. The US and Russia also approving a US resolution calling for a swift end to the war without assigning blame.
So the Wall Street Journal this morning is pretty scathing on the administration when it comes to what happened yesterday in the UN. Basically, this is a huge win for Russia, which they obviously view as an adversary, a sad day for the US at the United Nations. What's also interesting is the same day this happened at the UN, you still have the G7 absent of a joint statement because the U.S. was not on board with the rhetoric that the European Union and other allies wanted to use. That meeting was about 24 hours ago, and the G7, it's pretty remarkable, on the third anniversary of this war, they're unable to issue a joint statement.
So the UK, Starmer's coming over, right?
Starmer's coming over.
Prime Minister. The idea that maybe this shocks the Europeans into action. We could see some headlines later on today from the United Kingdom pushing for more defence spending. This is exactly what the president wants.
And we've also already saw it from Germany. They're talking about how much money, and that's why you saw moves in the bond market, how much money they want to potentially move on defense, because Trump is saying you have no choice. We are not going to do it anymore. This is a realignment, not just for trade, but also defense. He talked about this in Trump 1.0, and he's hitting them hard again when it comes to NATO defense spending towards their GDP.
The British Prime Minister speaking right now on defence in Parliament, saying NATO can trust the UK to put collective security first.
Yeah, this is essentially exactly what you're saying. Question is, does it allow the U.S. to cut their defense spending if you get an increase in spending in Europe? And is that sort of the bet that we're seeing with respect to some of the moves made on the Defense Department?
Look out for the headlines from Sir Keir Starmer, the Prime Minister, throughout this morning. We'll bring them to you. Let's turn to this story. The latest from Tesla, sales falling 45% in Europe last month. The slump coming as the company changes over production line to the Model Y and contends with Elon Musk's increasing involvement in politics. EV sales surging 37% in the region for the overall industry.
This is something we've been talking about. How much does what his political involvement has looked like in the U.S. become a liability for his company? On a broader level, I wonder if that will impact U.S. sales more broadly, or if this is incredibly targeted to specific people and specific companies, which so far it has.
YouGov conducted polls in Germany and the UK in mid-January, and they found that Musk was viewed unfavorably, and his meddling in the country's politics was unwelcome. At some point, is that brand destruction? His rhetoric on politics, does it make you stop to maybe want to buy a Tesla?
And buy what else? A very expensive German car instead.
Mercedes, BMW,
Chinese
a Peugeot.
Or a Chinese vehicle.
Yeah, exactly.
BYD.
Yeah, exactly.
Yeah. Okay.
Well, they got an entry point.
It's very competitive, that's for sure. Let's turn to AI. Will VanLoh of Quantum Capital expecting the industry to drive up energy needs, saying energy utility investments are projected to reach $200 billion annually from 25 to 2027, with a focus on electric transmission and distribution and generation to meet the needs of emerging industries like AI and cloud computing. Will joins us now for more. Welcome back. It's good to see you.
Thank you. It's great
As
to
always.
see you all.
Can we take a step back and just think about where energy's going in America? The sitting president talks about drill, baby, drill. Across resources, both energy and, say, basic resources, metals, we've seen a shift in the last decade or so away from volume towards value and cost discipline. Are you expecting anything to change anytime soon?
No, look, I think the U.S. Energy industry, which is primarily driven by oil and natural gas, went through some really challenging times as the shale revolution evolved through its early days. Today, it's probably one of the most profitable industries in the United States of America, and it's very focused on the bottom line, generating profits for investors, sending capital home to investors, and I don't think that's going to change.
How mature are those assets?
They are maturing. I mean, that's what you do have to realize, that the U.S. is now almost 20 years into the shale revolution. It started with natural gas back in about 2006 and then oil in about 2009. We have a lot more shale gas than we have shale oil here. People have heard me say many times that the U.S. is the Saudi Arabia of natural gas. But the oil fields are maturing, and outside of the Permian Basin, really, they're all in either peaking or will peak soon and go into decline.
Well, does that mean that you're going to end up with a smaller amount of production in the U.S., or does that mean that you can essentially have more efficiency in a lot of these places, but maybe not as many new discoveries?
Well, if you look at the last, say, 15 years, the United States has been responsible for 100% of global supply growth for oil, okay? So put that in context. A country that today produces a little over 20% of global supply was responsible for 100% of the growth. So as you kind of fast forward, can we keep growing like that? No. Okay, can we maintain that production? And today we're self-sufficient. We actually export a couple of million barrels a day of refined products and net on oil and liquids. We're energy self-sufficient, and we are a slight net exporter. Okay, can we maintain that for 10, 15 years? Yes. Can we maintain that forever? No. And I think that's where America has to get a very concise energy policy around kind of an all of the above, because we've got this window, this wonderful gift, quite frankly, that the shale industry gave the United States, which is we went from being the largest importer of energy in the world to the largest exporter, and in energy self-sufficiency for a period of time. And so that's a window, though, that won't last forever.
Do you have a clear sense of what the energy policy is from this president, other than just produce more?
Yeah, I think he's been very clear about kind of, I'd say, four primary objectives. One is obviously to produce more oil and gas and allow the build out of the infrastructure, the pipeline systems, LNG export terminals, things like that, to facilitate the growth of oil and gas and get it to where it needs to go.
He's also very focused on reforming, allowing things to get built. You know, a lot of people say build, baby, build, not drill, baby, drill. And I think that is very much the theme. You know, there's a tremendous amount of power infrastructure we have to build, transmission lines, grid upgrades. So I think that's kind of his second key pillar. I do think that on certain kind of the key parts of the supply chain, for certain aspects of the energy transition, renewables, batteries, things like that, I think they want to bring that back, the supply chains back home. So that's going to be good for American jobs and manufacturing. And I think the fourth thing is a nuclear renaissance. I think that is something they've been very clear about. Really, nuclear is the ultimate form of clean energy. It's the only base load clean energy that we have, or ever probably will have. And so I think that those four things kind of form the pillar of Trump's energy policy.
Last night, Trump was truthing, and he was saying, I was just thinking that the company building the Keystone XL pipeline that was viciously jettisoned by the Biden administration should come back to America. Now, I'm not sure if Keystone Pipeline is going to come back, because that company says we've been here before, we've invested money, and it didn't do us any good. But how do you invest when policy swings specifically on energy every 4 or, if you're lucky, 8 years?
Right. That's the issue, because so many of these projects are long cycle time projects, and the payouts are measured in decades, not years. And so that uncertainty keeps a lot of capital from coming into the space that needs to come into the space. The beautiful part about the shales is it's very short time cycle time. And so that actually lots of companies can make those investment decisions because it's 1 to 2 year cycle times, not 6, 8, 10, 12 year cycle times.
But what if we need long-term projects like getting Canadian crude into the United States?
Right.
Are people just going to say, even though Trump wants easy regulation, easy approval, drill baby drill or build baby build, it's still not worth it because we don't know what happens in 4 years' time?
Well, I think if they can get built in the next 4 years, they're not going to get turned off, right? So I think that the challenge here is what projects can get done in the next 4 years. And I think that's what he's trying to do, is find projects he can fast track and get built very quickly. If we do have a change in administration next time in 4 years, it's less friendly to the traditional energy business, then the same thing will happen. It just swing back the other way, right? And so that does make it, as an investor, that's the most challenging thing we face to deploy capital, is changing regulations and uncertainty about our ability to generate the returns that we have to generate for our investors' capital.
Were you spooked by DeepSeek at all?
I wouldn't say I was spooked by it. And I'm not an expert in AI, so I'm not going to pretend to totally understand it. But you all have talked a lot about it on your show over the last few weeks. I think it was, the old saying that necessity is the mother of invention, right? And I think the Chinese had to do something different. I do think that while it was a lot cheaper in training its models, it also relied on U.S. models as well for some of its cheap training. So I guess what I would say is, to me, the more the cost of AI comes down, the more it's going to get used. And so while that may use a lot less energy, I actually think more people will use AI in more things, and that will increase the demand for energy as well.
Will, appreciate your time. It's always good to see you. Thank you, sir. Will VanLoh there of Quantum Capital Group. I mentioned that, of course, because we get NVIDIA tomorrow after the bell, and that's the big earnings report of this week. Big headline coming from the United Kingdom, a series of headlines coming from the British Prime Minister speaking in Parliament, saying this morning: we must change our national security posture, and going on to say the UK defence budget will reach 2.5% of GDP by 2027. That headline, of course, timely, because he'll be sitting down with the President of the United States in the next several days.
Certainly this is timely. He's going to Washington, D.C., going to have that meeting with Trump. And, of course, we've seen Trump in 1.0 tell NATO allies that they need to get their defense budgets up. The problem is 2.5% by 2027. It'll be a welcoming step. But this administration is now talking about 5% when it comes to defense spending to GDP. So they might have a lot more work to do.
I remember coming into this year, it was that the U.S. would be growing strongly and you would have some sort of recession or downside shock in Europe. Right now, you have the prospect of increased fiscal spending in Europe and the U.K. and a potential fiscal constraint in the United States with a potential growth hit. It's just highlights how different the tone has been in the past 5 weeks.
Well, I'm pleased you brought that up because in places like the UK and France, some people might suggest they don't have the fiscal space to make these moves. So when you make a move like that, the question is going to be asked, what are you cutting to accommodate that kind of spending? And that's the next headline to drop, I imagine.
Well, that's exactly what I looked at, 10-year gilts. How much do you start to see yields popping up as people expect some sort of increase in spending? Right now, you're not seeing a dramatic move. Yesterday, you saw that move in boons. But at some point, that is the key, the fiscal constraint of what yields do.
Some important headlines coming from the British Prime Minister before his visit to the United States to sit down with the American President Donald Trump, saying this morning: the defense budget will reach 2.5% of GDP by 2027, and the defense budget will hit 3% of GDP in the next Parliament. The latest from the British Prime Minister speaking in Parliament this morning. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump is planning to toughen Biden-era controls over China's tech sector. The White House is sketching out more restrictive semi-curbs and pressuring key allies to escalate their own restrictions. Some officials want to further restrict the type of NVIDIA chips that can be exported to China without a license. Elsewhere in tech, Indonesia and Apple have agreed on a deal that will lift the country's ban on the newest iPhone models. iPhone 16s have been banned for 5 months as the Indonesian Ministry for Industry sought to negotiate better investment terms. As a part of this deal, Apple will commit to training locals in research and development and invest $1 billion in Indonesia. Former Republican presidential candidate Vivek Ramaswamy is running for governor of Ohio. The 39-year-old Ohio native is vying to succeed fellow Republican Mike DeWine in next year's gubernatorial election. Ramaswamy had been named by President Trump as the co-head of the Department of Government Efficiency alongside Elon Musk before he withdrew from that role. Trump endorsed Ramaswamy for governor in a post on Truth Social. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in the next 30 minutes or so. Up next on the program, the bond rally continues.
The underlying conditions that we need for yields to come down, for growth to go back up. 10 years come down, or rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great.
Well, it continues this morning. Yields are down by close to 8 basis points on the 10-year. Up next, Tom Tzitzouris of Strategas. Live pictures from Parliament in the United Kingdom as they just respond to some important headlines coming from the British Prime Minister. UK defence budget to reach 2.5% of GDP by 2027. To Keir Starmer, the Prime Minister, going on to say the defence budget will hit 3% of GDP in the next Parliament. How will we fund this, you might ask? UK foreign aid will be cut to fund defence. What does that sound like?
USAID. I mean, this sounds exactly like what happened in the United States, although it's coming to increase spending on something that has been underfunded for years.
He will sit down with the American president later on this week. Donald Trump, look out for that conversation. We're all fixated on the bond market here stateside. Yields continue to drop. We're down by 7 or 8 basis points on a 10-year, 432.32. Under surveillance this morning, the bond rally continues.
What's necessary are the underlying conditions. So the underlying conditions that we need for yields to come down, for growth to go back up. We've got this affordability crisis in housing. We've got an affordability crisis in the auto payments. So one thing that would be very stimulative, the 10 years come down, or rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great.
It continues. 10-year bond yields falling for 5 consecutive days, dropping to a 2-month low. Tom Tzitzouris of Strategas writing debt ceiling-driven liquidity will enter the market in large numbers this week. This should temporarily lower longer-term bond yields, mortgage rates and corporate spreads. Tom joins us now for more. Tom, welcome to the programme. Let's talk about the last 6 weeks, not just the last 5 days. What's been driving this move in fixed income?
Yeah, and good morning. Thank you for having me. I think there's really 3 things that have driven this drop in yields. The first one is pretty much played out, and that is the realization that the global trade war is not going to come to fruition. Worst case scenario is not going to play out. Even maybe the semi-worst case scenario is not going to play out either. we're very likely to still have tariffs along the way, but the trade war, worst case scenario, is no longer on the table. That's pretty much played out, and the bond market has taken that risk off the table. Point number two, we're starting to see now is really filtering into the bond market, and that is the realization that we're right now in the midst of what I call a seasonal slowdown. Middle of Q1 and late Q3 are our seasonal slowdown periods because of consumer debt hangovers. And we're in the midst of that right now. And there's always a concern that that seasonal slowdown will become a prolonged slowdown. And that's where we are right now. And the market's starting to fear that this is becoming a consumer pullback, especially now without the tailwind of fiscal stimulus at our backs. And point number three, and the debt ceiling is part of this, and this is also playing out particularly this week, is that there's a realization that the worst case scenario on Treasury supply is temporarily off the table. And what I mean by that is coupon auction increases are not slated for this quarter, next quarter, and probably not even third quarter. That means fourth quarter and later. So the market doesn't have to worry about that right now. On top of that, the debt ceiling has been hit. We're in extraordinary measures. Cash is coming into banks today. That does tend to flatten the Treasury curve temporarily. And then last but not least, there was some commentary from the Fed in the minutes suggesting that there is an appetite to end quantitative tightening somewhat in the near term. That could mean early Q2. It might mean late Q2, but they're not now starting to have a conversation. Whereas a month ago, it seemed like this was just an indefinite policy, quantitative tightening. So all of these factors have helped to push yields down. But this week, particularly, the debt ceiling cash is the big force.
Tom, there's a lot to pick through there. I want to just emphasize one point you said, that this is essentially the bond market saying that the idea of a trade war is off the table. So you disagree with Jordan Rochester's assertion that tariffs are no longer being treated by this market as inflationary and just view it as actually people not taking a lot of these threats that seriously?
Well, I think it's both. I think there was an overreaction late last year, perhaps because it was pushed out through media sources that tariffs were going to be explosively inflationary, exponentially inflationary, were some headlines I'd seen, and that was just never going to happen. But now I think there's also a realization that these are going to be, if they do happen, tariffs, they're going to be incremental, they're going to be targeted, and there will be dialogue back and forth. So the risk of a trade war seems less likely as well. So it's both. It's not just that there's going to be less chance that it's an explosively inflationary environment, but there's also a chance it's more likely that this is just not going to play out to the worst case scenario.
Hey, Tom, appreciate it. Tom Tzitzouris there. Strategas, 6 weeks of falling 10-year bond yield stateside, and it's quickly becoming week 7. The 10-year down by 8 basis points this morning.
And a real question about the consumer confidence data that we get later this morning, 10 a.m. Eastern. Does it confirm what we got out of the University of Michigan Sentiment Survey? Mike Wilson of Morgan Stanley is saying it's really important to look at this one because of its labor sentiment aspect as opposed to simply just spending.
That data point taking on additional importance after the numbers we saw on Friday. And not just the numbers Friday, retail sales have been softer. Walmart spooked people a little bit as well. So look out for that later on this morning. Coming up next in the next hour of Bloomberg Surveillance, we'll catch up with Tom Kennedy of JP Morgan, Bloomberg's Mark Gurman and Neil Dutta of Renmark. Plus later, David Rubenstein sitting down with the Bank of America CEO, Brian Moynihan. We'll take that live and in full right here on Bloomberg TV.
The market is very quick to react and change narratives that we're in a Goldilocks scenario and then very quickly say, oh, no, this is recessionary.
With the broadening of the rally that we've seen, we've also seen a broadening in terms of earnings growth.
In terms of kind of the earnings story of the United States relative to the rest of the world, it has been driven by big tech.
It's really the tech sector that is very vulnerable, not because they're not making money, it's just that their valuations are too high.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bow stateside. Equity futures on the S&P 500 just about unchanged to positive by almost 0.1% on the S&P 500 following a 3-day slide. On the Nasdaq 100 shaping up as follows, totally unchanged as well. This is child's play. The interesting stories in the bond market. 2-year, 10-year, 30-year, driving lower across the board. 6 consecutive weeks of lower yields in America, a run we haven't seen in more than 5 years. The 10-year this morning down by 7 basis points, 432.51, and driving lower once again.
The tail risk is no longer, at least at the moment, the prospect of inflation reaccelerating. And that has totally shifted the narrative where suddenly, as Michael McKee pointed out, you have 2 rate cuts now being priced into the U.S. market coming through the end of this year by the Federal Reserve. Does this change the narrative once again? Or maybe people are looking for some sort of growth shock to the upside. Maybe there'll be a little bit of a hit on the margins. But the Fed may be coming a little bit more into play after being sidelined for a bit.
The next stop for this conversation, 10 a.m. Eastern Time, 2 hours away, when we get another read on consumer confidence. Consumer confidence a bit softer than expected in Friday's read over at Mitch, and inflation expectations a whole lot higher.
Inflation expectations a whole lot higher. One caveat, Jonathan, you mentioned earlier in the program, which is why this 10 a.m. data point is very important, is the political bias that goes into the University of Michigan. Democrats are not feeling very excited about inflation prospects or what is going on. They're concerned about tariffs. Potentially we get a little bit more of a clearer read at 10 a.m., especially at a time when this market and market participants, the angst is about trade. Because Donald Trump said last night, their tariffs are going forward, they're on time, and they're on schedule.
It's Tuesday. Let's talk about feelings and consumer feelings. Sometimes when they say that they're not feeling so happy, especially on a survey that they answer online, and evidently they're more unhappy online than they are over the phone, it doesn't translate into less spending. And we have seen that consistently. Now we get prognostications from CEOs about the uncertainty going forward and very low benchmarks that they can easily cross later this year should that change. How do you put this into a picture where you can point to one indicator showing real strong growth and another showing real deceleration?
You buy bonds, apparently, and that's what's been happening for the last month and a half. Yields lower across the board once again. Equity futures just about positive by 0.1%. Coming up this hour, we'll catch up with Tom Kennedy of JP Morgan, with stocks looking to snap a 3-day losing streak. Bloomberg's Mark Gurman looking ahead to Apple's shareholder meeting, and Neil Dutta of Renmac on why he's not constructive on the U.S. economy. Neil joins us in about 30 minutes from now. We begin this hour with stocks lower as traders weigh fresh tariff concerns. Tom Kennedy of JP Morgan writing, our base case remains that additional tariffs will be levied on China and other countries. For national security concerns, the risk of broad-based tariffs remains, but we think it's a low likelihood. Tom joins us now for more. Tom, good morning.
Good morning.
What instructs that view? What guides it?
I think it's just the assessment of how things have changed over the last 10 years in the global supply chain paradigm. China has been supplying the world's critical industries and oversupplying them for a long period of time, making the rest of the world reliant on them for critical minerals, batteries, and processed minerals that go into all electrical products that we go through. So when you look at the tariff, it becomes a critical way to slow down that integration into supply chains from China, but you will eventually need subsidies to rebuild, and that's a common thread between the Biden administration and the Trump administration so far.
It's not just tariffs on China, also a levy potentially of 25% on Canada and Mexican imports as well. The president yesterday was pretty clear. Tariffs are going forward on time, on schedule. Do you buy that?
It's not our base case right now that happens.
It's a week away.
It's true, but the last go-round, we went to the last hour too, so it is possible to keep that going. And when you look at just the trade dynamics between Mexico and Canada, this is well discussed that we are, America, are the biggest importer. We rely on them critically for their inputs, but as a percentage of GDP, those exports from Mexico and Canada are a big piece of their GDP. So there is a lever that America can pull to get what they want. The question is, if we are negotiating, what are we really negotiating for? That still remains pretty unclear to us. So that's what we'll be looking for in the next week or so. Are we negotiating? And if so, what are we negotiating on?
The past 5 weeks have been a really exhausting exercise in deciphering signal from noise, I think, for a lot of people. And it sounds like what you're saying is that tariffs right now, barring a couple of them, are more noise than signal when it comes to what's going to come into effect. So what's the signal? Where are you getting that?
Well, just let's hit the noise for a second. When you look at 2018 and 2019, the market's reaction to tariff announcements, the S&P 500 was moving 2.5% on those announcements. Now you're talking about tariffs that are substantially bigger, and the market's moving 50 basis points, 30 basis points. So I think the market is doing a better job this go-around in this Trump administration than in the first one of finding that noise and saying, I'm not so worried about that. But when you look for really what is the signal, what is the big picture here that we're trying to solve? Is the big picture trying to solve migration trends from Mexico or from Canada? Maybe. Is it fentanyl? Could be. But the bigger issue of national security isn't really relying on Mexico and Canada. It has to do with, I think, this reliance on China. And just to sit in front of any person, any client, and say 80 to 90% of NVIDIA's chips are made in Taiwan, that could say the dominant reliance we have on one specific product becomes a national security issue. It has nothing to do with one company, just of that type of reliance becomes an issue in of itself. And then you can start to look at processed minerals from China. 90% of the world's processed minerals for electrical motion come from China.
So what's the market signal there? Because these two economies are deeply intertwined.
Yeah.
There is something that we've been talking about. John brought this up earlier. You know, a lot of people agree that this should be done, but there will be some pain as a result of it. Do you see pain that's not being priced into the market as a result of some of these trade practices and some of the goals that will go into effect?
I think I just see the market playing the downside of what will actually be implemented. The tariffs is one case. And when you start to look at some of the other policies, whether they be immigration, deregulation, the market is now just muting what they think will actually come through. On the deregulation side and capital markets activity, we're 2 months into the year now, and things really aren't picking up. They're not picking up in the way that we thought they would. I think you still need to give it another month or so to see if it's really true. But these high expectations that we had for the impact, I think the market is now saying, it's quite unlikely we'll get that full impact.
What I hear from you is it sounds like Trump 2.0, the market has almost become numb to everything he's talking about, especially in the trade world. Is that accurate, though? Because Mike Wilson was on saying that maybe this time is different. Trump isn't coming out truthing every time there's a new stock market high. Maybe he's not regulated as much by where the Dow Jones is.
I think this time is certainly different, right? He came out of his inauguration day with pronouncements, executive orders that we hadn't seen in the past. That is different. But I think what's similar is the fact that we had high expectations for big market and economy impacts. And it's hard to get all of those things done as fast as we all thought that they could be done. So we're seeing a slower on-ramp for that.
One part of your thesis is accurate, the base case that additional tariffs will be levied on China, in the sense that those are the only tariffs this administration has actually levied on.
Only thing that's stuck so far.
10%. How high do you think it goes?
Our baseline is that you'll see tariffs go up another 10 or 20% on China. If you actually want to do this separation, it has to be meaningful and it has to be impactful. But again, if it's national security, if that is the end game, and to be clear, we do not know what the end game is. We're trying to figure that out.
He says reciprocity.
Well, reciprocity becomes more impactful for the economy. I teach my children the world is not fair, but if you look at trade right now, it is very unfair. Most of the goods that America exports is tariffed more than what we tariff for things we import.
Yeah.
But if you do that, what you end up having is a price shock higher, which will likely mean growth down. That's the stagflationary end game that would be quite negative for the market.
Let's go with your additional tariffs on China. What would you avoid? What would you go into based on that call?
I think in that AI trade, it favors software over hardware. That transition is happening, and after the DeepSeek announcement has already happened. But if those tariffs get levied some more, there are individual names you can pick out, and I think you guys do that well on the show already. But then also it does favor the bond call. I mean, you're moving into a world where higher tariffs, if that is the only thing, does have this unlikely effect of higher prices and lower growth. And the Fed, what we learned from them is they tend to favor the lower growth outcome. And I think that's a piece of what's happening in the bond market in the last couple of weeks.
That's what the front end might speak to. What does the long end speak to?
I think the long end is speaking to you that this big worry about the deficit exploding is not as big. The supply concerns are not as big. But I think it's really just simply economics.
Yeah.
In that U.S. Growth outlook is a little bit muted to the downside. And that's the dominant driver of the 10-year. And when you start to play with some of your models, they're very similar on Wall Street. Take a Taylor rule model in the front end, it says you should cut 1 or 2 times this year. That's kind of where the market's pricing. And at the moment, your premium in the long end is actually still very small compared to what we've seen over the last couple of years.
Mike Wilson of Morgan Stanley was on earlier, and he was saying it's a trader's market in the stock market. Is it a trader's market at the long end of the yield curve, or is it a buyer's market?
I think it's going to be a trader's market for a while. And it should be in this, when we're in this phase of the Fed giving you no guidance, and we're actually going to see individual prints driving the market. And you can simply just look at the MOVE index where you're seeing still relatively elevated interest rate volatility. That's a trader's market until we get firm signal of which way we're going. Towards the back half of the year, if our baseline is right, the Fed will be back in market cutting, not aggressively, but still a few more cuts that would be necessary just to firmly rebalance the economy.
Bond yields down across the curve this morning. Thomas, good to see you. As always, Thomas Kennedy there of JP Morgan Private Bank. We're down by 5 basis points at the front end of the curve, 411. On 10s, new lows for the year. We're down 7 or 8 basis points to 432. With an update on stories elsewhere this morning with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. UK Prime Minister Keir Starmer affirmed his country's commitment to increasing defense spending. Speaking about 20 minutes ago, Starmer said the UK will increase its defense spending to 2.5% of GDP by 2027. And will aim to increase that to 3% in the next parliament, should conditions allow. Starmer going on to say that the hikes in defense spending will be paid by cutting foreign aid, not by taxes or borrowing. Bloomberg News has learned that Elon Musk's SpaceX is seeking to deploy Starlink satellite internet terminals to help upgrade the Federal Aviation Administration's national airspace system. The effort raises questions about conflicts of interest for Musk's business empire and the future of a $2 billion contract that was awarded to Verizon in 2023. Former New York Governor Andrew Cuomo is reportedly on the verge of running for mayor of New York City. The New York Times is reporting that Cuomo may announce his candidacy as soon as this weekend. He resigned from office in 2021 over sexual misconduct claims. Cuomo denied the allegations. And that's your brief, John.
Danny, thank you. More from Danny a little bit later. Up next on the programme, the Morning Calls Plus. Bloomberg's Mark Gurman with a preview of Apple's shareholder meeting. That conversation up next. Equity futures just about positive by 0.1%. The opening bell, 1 hour and 15 minutes away. Equity futures just about positive. In the bond market, this decline in bond yields continues. Yields are lower by 6 or 7 basis points. The 10-year 4.33. We'll come back to that in about 15 minutes' time. Let's get you some morning calls. First up, Barclays lowering its price target on Toll Brothers to 101, citing the company's cautious tone around demand. That stock is up by 1.3%. Your second call from Argus, downgrading Domino's Pizza to hold, noting higher food prices and labour costs. That's one to watch. Stock is down by 0.4%. And finally, Citi raising its price target on Hims and Hers, citing multiple avenues for growth following the company's earnings. That stock getting hit for very different reasons this morning. We're down by about 21% in the pre-market. Let's turn to Apple. The company holding its shareholder meeting later on today. Investors set to vote on a motion that would force the tech giant to scrap its DEI policies. Bloomberg's Mark Gurman joins us now for more. Mark, welcome to the programme, sir. Got to build on your story from yesterday morning, which got a ton of attention. The statement from Tim Cook on increased investment into the United States, increased hiring into the United States. Was that a message to shareholders or a message for the White House?
I think it was a message for one man, and that would be President Donald Trump. It's pretty clear that Apple wants to avoid tariffs, particularly on the iPhone, right? That 10% additional tariff on goods imported from China would be not destructive, but would be, I guess, hurtful to Apple's bottom line, specifically the margins on the phone. They definitely don't want to have to deal with that. And so what they've done here is they've essentially taken investments that they had already announced years ago or planned to implement, talking about 5,000 R&D hires a year, investments of $125 billion in U.S. interests every year, and they announced it and put it in a pretty package for Donald Trump to see it. Now Trump is able to go back to his supporters, go back to Congress, go back to the citizens of the United States and say, I got Apple to invest $500 billion into the U.S. Now, that's not true. They were essentially doing that anyways, but Trump gets to claim that. And in exchange, Tim Cook probably will end up getting a reprieve at some point on tariffs to some extent.
Well, adjusted for inflation, $430 billion in 2021 is basically the $500 billion today. So the commitment he gave to Joe Biden, he's giving to President Donald Trump yesterday. But the key is he wants this flashy proposal because of potentially a carve-out. What could that carve-out be when it comes to tariffs?
Well, we just look at what happened last time, right? In the first Trump administration, Apple didn't get an additional tariff on the iPhone in the end, right? Tim Cook made these same maneuvers, 7, 8 years ago at the beginning of the previous Trump administration, and the iPhone didn't end up getting slapped with tariffs. You saw some tariffs on some other lower priced Apple products, AirPods, some of the Macs, some Apple Watches, some keyboard accessories, cables, chargers, etc., computer components, but that really would not have as significant of an impact as tariffs for Apple on the iPhone. Back then, Tim Cook, and I'm sure he made the same argument again, said that Samsung would stand to benefit, right? Apple, they make all their stuff in China, but they are still an American company based in California, right? Samsung, they make their stuff overseas. They import a lot of it into the US, but they don't make their stuff in China. So they wouldn't be subject to tariffs to the same extent as Apple. And by the way, they're not a US-based company. They're a South Korea-based company. So that was, I think, a pretty good argument on Tim Cook's point. The same argument he made again, right? But now you combine it with these press releases showcasing that Apple is making changes and believing the United States, timing it, right? I mean, I think it was very clear that the prior announcement, that came in 2021 when Biden had a few years left in his administration. But Donald Trump started his second term about a month and change ago, right? He was inaugurated mid-January. We're in mid-February. And Apple's announcement was very clear to say over the next 4 years, right? So this is very much phrased in a way for Trump to be able to present it as something specific and special to his term.
What I find fascinating about this, Mark, is that Tim Cook's response to the threat of tariffs is to kiss the ring. It's not necessarily to shift production more rapidly out of China or shift a greater proportion of business away from China. Is that basically the core of it?
Well, it's not possible to shift the majority of production outside of China. Don't forget, Apple spent 25, 30 years building up its supply chain in China, and you can't just rebuild that even over 10 years in another part of the world. There are so many idiosyncrasies, so many specific things in China that make it palpable for Apple to produce there that really can't be replicated in other parts of the world to the same scale that it is in China today. They're doing some iPhone production now in India. They have some production going on in places like Brazil. You're seeing AirPods and Apple Watches and Macs being produced in Thailand, Vietnam, Malaysia, right? You're going to see some production be done in Indonesia. But for 95% of their products, that they're still being produced in China because Apple does not have an alternative to be able to produce at the same costs, fit and finish, and scale as they're able to do with Foxconn in China and across the region right now.
Mark, it's really important to address this and just build on it a little bit more. 20 years ago, even 10 years ago, we would have all sat here and said it's about cheap labour. And Tim Cook's made the argument that it's not about cheap labour at all. It's about advanced labour, being able to find people with the skill set to do this job. How important is that with regards to China at the moment?
I think it's one component, right? I mean, you're going to get labor at similar costs to China, right? In Vietnam, Malaysia, Thailand, Indonesia, Brazil to some extent. But what you're not going to get is the sheer scale, number of people, and sizes of these factories, who, by the way, have been doing this stuff for 20 years, so they have the experience, right? Apple is not going to risk quality, right, in order to move its supply chain. The quality of their products and their hardware is what allows them to price their products and have these immense margins. So it's not about how much they're paying these people. It's about how many people they're able to get. It's how many people they're able to get within the manufacturing culture in China. It's how many people they're able to get with the experience they need. And it's the equipment and machinery and different machinations of how this is all done that they've really set up for the past 2-3 decades. So it's going to take time to move everything. Even if Apple started relocating its supply chain right when Donald Trump took office in 2017 the first time, we're in 2025. They wouldn't be anywhere near the finish line at this point. This is a multi-decade effort, and I quite frankly don't think it's ever going to happen. We've been talking about this diversification for years, and that's all it is. It's diversification. It's not relocation.
Tim Cook, the ultimate diplomat, is in a really precarious spot. And as I hear you talk, I just think more and more. On one hand, Apple is creating partnerships with the likes of Alibaba to try to advance some sort of artificial intelligence in China, at the same time that they're trying to placate Donald Trump and his desire to bring business and to bring jobs back to the United States. Is there a sense that he will not be forced to choose? And if he is, that could be catastrophic for the business?
Well, let's talk about Alibaba for a second and China. That's placating also. Apple knows that it's not going to be able to sell as many iPhones as it would like to in China if it doesn't have AI. Now, I'm not going to sit here and argue that Apple's AI is good or bad. Okay, fine, I'll tell you, it's not so great compared to the competition. But from a marketing standpoint and from we have that feature too standpoint, it's essential to have in places like China especially. So Alibaba, that partnership is also placating because they can't sell iPhones with artificial intelligence in China by law unless it has what I call a censorship engine, right? A place or a feature within the iPhone where if China, the government there, the technology-based regulators there disagree with an AI-related output from the iPhone, right? They need a middleman there to be able to fix that, to block, to censor, right? To modify content. And so the Alibaba partnership is essentially a layer on top of Apple's on-device large language models on the iPhone, right? That can shift the models, change the models, and update the content on the iPhone at the behest of the Chinese government. So you are seeing Apple placating in other areas of the business. And Apple always talks about how it follows the rules and regulations of the countries it operates in. And Tim Cook's ethos from the beginning has been to make adjustments to a certain extent, and in many cases, a dramatic extent, in order to keep selling their products in the region. Apple doesn't want to cut back on margins. Apple doesn't want to lose any revenue over a disagreement with the government. So they're going to do whatever they can in any country to keep things moving. Another example last week was in the UK. They pulled a feature called advanced protection, right? This is a feature that enables end-to-end data encryption for your files stored in the cloud through Apple on iCloud, things like messages, things like notes, reminders, right? So that is being pulled, right? Advanced data protection from China, or from the UK. It actually is in China, but it's pulled from the UK because the UK asked Apple to build a backdoor into its devices globally so the UK government can infiltrate the data of anyone it would like to. And instead of building that backdoor, they basically
controversial over the last few weeks on that front. Mark, we've got to leave it there, sir. Thanks for joining us. Mark Gurman there of Bloomberg on Apple. The story of Apple, just to hear Mark talk about that with regards to China and production. We're in China for quality. In China for quality. Not because of cost. Cost, of course, is a part of that. But in China for quality, that's a new part of the China story over the past few years.
And they've pushed to have more skilled labor. It's also the point about why all of NVIDIA's chips are produced in Taiwan. It's not because of being cheaper. It's the quality and the sort of supply chain of talent.
Up next on the program, we'll catch up with Dutta of Renmac on why he sees a slowdown in the labor market and the broader economy. That conversation is up next. Equity futures positive here by a little more than 0.1% following a 3-day slide on the S&P 500. We have a bounce, just a small one, up by a little more than 0.1% on the Nasdaq 100 with 60 minutes until the opening bell. With your morning movers, here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with Eli Lilly shares. Those are getting a bit of a boost here in the pre-market, up 1.5% on the news that it plans to cut prices on some of its obesity drugs. And this is a way for the company to stave off competition from the cheaper alternatives out there because, as I said before earlier, the FDA is trying to clamp down on this, but they can't get everyone. So Lilly says you can expect to pay about $50 less for its Zepbound vials. Next up, we have Chegg, the company that helps you study getting clobbered here in the pre-market, down nearly 22% as it faces increasingly tough headwinds due to generative AI because, as Lisa knows, all the kids use ChatGPT these days to study, and it's gotten so bad that Chegg is now weighing strategic alternatives to its business. And I wanted to end with something sweet, but there is nothing sweet about Krispy Kreme shares right now, down about 15% in the pre-market. Fourth quarter revenue came in weaker than expected because of a hacking incident that happened last year, plus the sale of its majority stake in Insomnia Cookies. That was a more than $100 million hit to revenue. But the outlook doesn't look good either, and that's also what's weighing on the stock here. John?
Yeah, thank you. Just seeing you get very excited about Insomnia Cookies.
Yeah, it's my guilty pleasure because they have a gluten-free vegan cookie.
Okay.
Then it's healthy. Then it's super healthy.
Super healthy.
I'm not saying it's healthy. I said it was my guilty pleasure.
All I can say is those two things put together. You do generative AI, do your homework, and you sit there and eat Insomnia Cookies. That's
gluten-free, dairy-free.
Yeah, it's the way to...
Vegan cookies, they're so healthy. Let's turn to the economy. Neil Dutta of Renmac raising concerns on the labour market, writing much of what we see in the financial press, tariffs, uncertainty, is a red herring. An ex-post rationalisation for an economic slowdown that was already in motion. For the economy, expect conditions to deteriorate further in the jobs market. Neil joins us now for more. Neil, welcome to the programme, sir. As soon as you hit publish yesterday, we talked about that note. Fantastic read. Neil, just share with us why you think this is a train already in motion. It's not about the last month.
Well, John, I'm beginning to have second thoughts already because I see Annmarie rocking Fendi on the program, so it must be a bull market, no?
Vintage.
Someone's spending, Neil. She says it's secondhand. I don't know if it is.
Sure. No, all I'm doing, John, is just applying the playbook from late 2022 when we made that no landing call. Remember, if you recall, it was basically four things: real incomes, housing, government spending, and just the way the consensus was positioned, right? So you fast forward to today, real incomes are slowing as the labor market continues to cool. The housing market is getting worse. Even though the Fed had been cutting, state and local governments are pulling back. The Doge gets all the attention, but really state and local government spending has been a meaningful tailwind to growth, and that's likely to go the other way. And if you look at the consensus, I mean, back in late 2022, everyone was positioned for, essentially recession. I mean, people held onto that view, believe it or not, through the middle of 2023. So one of the ways, it works is through an element of surprise, right? I mean, if everyone expects recession and it doesn't happen, you have to have this sort of period of catch up. By contrast, if everyone is expecting things to be fine and then they're not, that could, prompt a clearing out of inventories, hiring, investment, and so forth, and kind of create a negative feedback loop with the economy. So that's kind of what I'm concerned about. The data hasn't been particularly encouraging of late, and I'd expect that to continue until the Fed gets on the right side of the eight ball.
Well, Neil, let's talk about the Fed. We all said yesterday, what's worse than a slowdown? And it's a slowdown the Fed's not willing to respond to anytime soon. Now, the Federal Reserve was willing to get ahead of something last year. They dropped rates by 100 basis points across 3 meetings. What changed coming into 25?
Well, I mean, they're basically taking out an insurance policy against the new administration. That's basically what happened. I mean, if you look at the adjustments to their risk assessment around inflation, the notion that they're simply innocently responding to the inflation data, I think, is a bit ridiculous. The upside surprises on inflation that we saw in the back half of last year paled in comparison to the upside surprises we saw in the first half of last year. And, the risk assessment didn't change all that much. So, to me, this kind of feels eerily similar to the period between June 2024 and September 2024. We went, if you recall, I mean, the Fed basically went peak hawkish in June, and then 3 months later, they're cutting 50 basis points. So I think where I'm at right now is the Fed is waiting for permission from the markets and the data in order to respond. And that's essentially tempting fate. I mean, if you're waiting for something bad to happen, before you move, chances are something bad will happen. I mean, what changes the trends that we're seeing at the moment?
Well,
absent some kind of Fed response.
Well, but Neil, I think that a lot of people are picking up on the same thing that you are. And suddenly the idea of tariffs is no longer considered so inflationary, and it's considered more of a growth shock in the absence of some other pro-growth measures. Right now, it seems like the bond market is turning around to your side. Now we've got 2 rate cuts being priced into the market through year end. Is that enough to make you more positive if the Fed does go through with a 50 basis points of rate cuts by the end of this year?
No, not really. I mean, I think the Fed will need to do more than what's priced because the economy is weaker than they think. It's really that simple. I do find it kind of amusing how everyone is basically using tariffs and policy uncertainty as a rationale for their forecast adjustments now. I mean, to me, it's a bit rich, as if, if you thought that, I mean, why didn't you make your changes back in November after the election? It's not, I mean, the guy ran on tariff being his favorite word in the dictionary, and now you're surprised that he wants to go through with it? I mean, it's crazy.
But hold on a second, Neil. But let's just be clear. It's not just that he's going through with tariffs. It's, as John has mentioned many times, the sequencing of it, that there isn't a clear path for some of the offsets with respect to the tax cuts and the pro-growth measures, and you're not seeing the boom in deal activity. That's the reason why people are focusing more on the growth hit from tariffs than they are inflation, no?
No, I mean, I think what I'm seeing more is people talking about policy uncertainty related to the Trump administration, and that's why they've gotten cautious all of a sudden, and why there will be a freeze in sort of investment and so forth. I mean, to me, it's ultimately demand that's going to be driving the discussion, and household demand is slowing because the labor markets continue to cool. The tariff stuff, I mean, again, this is all just sort of ex post thinking. I mean, uncertainty would be high if the shoe were on the other foot, right? Because we'd have one of the largest tax increases ever, potentially, at the end of the year. You don't think businesses would be worried about that? So it's just sort of like this heads I win, tails you lose type of analysis that I think is a bit ridiculous. I think everyone should just focus on the here and now, including the Fed. Instead of trying to take out an insurance policy about what may happen or may not happen, I mean, Congress is very evenly divided. I mean, the sort of fiscal expectations that people had baked in after the election, you could pin that at the feet of Congress, right? I mean, so it's not just the Trump administration from where the uncertainty is coming from, but I think it's wise to just focus on the here and now. And what the here and now tells me is that demand is slowing down, housing is still weak, and inflation is likely to continue to moderate as rental inflation keeps cooling off.
He knows his Fendi, and he nailed it at the end there. Neil Dutta of Renmac. Neil, got to catch up. Longer conversation when you're back in the studio next time here in New York. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Elon Musk said federal workers will be given a second chance to respond to an email detailing what they did last week or face termination. The federal agency that sent the email on Monday said it's up to the agency leadership, not Musk, on what happens to those who ignore the message. President Donald Trump defended Musk's efforts, saying that it is a legitimate bid to root out fraud and waste in the government. Elsewhere, AI startup Anthropic is said to be nearing a deal to raise $3.5 billion. People familiar with the matter say that the funding round would value the company at almost $62 billion, which is more than originally planned. The Philadelphia Eagles appear to be White House bound after all. Earlier reports suggested that the Eagles had turned down an invitation from the White House to attend a ceremony to honor their win. A source says with the team confirmed that they would be honored to visit, though the White House has not yet sent a formal invite. The Eagles did not visit President Trump's White House when they won their first Super Bowl in 2018. And that's your brief, John.
Danny, thank you. Appreciate the update. Thank you very much. Now I want to take you over to the Economic Club of Washington, where I'm pleased to say that David Rubenstein, the Carlyle co-founder and host of peer-to-peer conversations on Bloomberg TV, is joined by a good friend of this program, the Bank of America CEO, Brian Moynihan. Let's take a listen.